So based on popular demand, we have two outstanding illustrations that we are going to test on business valuation. The primary question would be the latest question on business valuation, which was tested May 2025 diet. All right. So after we are done with that, then we are going to have additional illustration that relates to valuation for stock for the purpose of stock exchange listing. All right. Then thereafter, we then move to discussing the merger and acquisition. Like I told you, M&A is purely theoretical. All right. It's purely theoretical. That it can't take us more than 30 minutes to complete. All right. So without wasting more time, I need one of you. Let me look at I would like, let me see the participants. All right. Wumi, are you available to read the question for us, please? All right. Wumi? Okay. If Wumi is not available, can I have anyone to read for us? Nikki, you want to read?
Okay, sir. Okay. Question 1. Collar PSA is a large listed company involved in two business sectors. Its main business is the production of food and drink for supermarkets and other large traders. It is also owned a chain of restaurants nationwide. Collar's board of directors think that the company is undervalued, and it is of the opinion that it should focus on the rapid innovation taking place in the food and drink production sector. Therefore, Collar's BOD has decided to onboard the restaurant business into a company called ZK Limited. And Collar PLC can either spin off or sell ZK Limited after the demerger so that Collar PLC can focus on its remaining business of food and drink production. Initially, Collar's PLC can focus on what am I reading? Initially, Collar's PLC shareholder will own ZK Limited on the basis of owning one KZ Limited share for every Collar PLC share owned by them. MK Limited is a large unlisted company controlled by 20 shareholders who all have a significant stake in the business. MK Limited owns a number. Where did I stop? Okay, owns a number of hotels around the country, and it is looking to diversify into the restaurant business. MK Limited has approached Collar PLC about the possibility of purchasing ZK Limited. MK Limited will finance the purchase either through a cash only or after a share for share offer. If ZK Limited is demerged, it will be listed on the stock exchange as an independent company. Collar PLC is unsure whether to sell ZK Limited to MK or demerge it into an independent company. Extract from the Collar's financial statements as follows. So we have so Collar PLC shares are trading at 2.4 naira each and have an equity bidder of 1.3. The part of the business which will become ZK Limited accounts for 24.5% of Collar's total equity value. Collar PLC loan notes a currently what's this? Collar PLC. Okay, loan note A. Thank you, sir. Currently have a total market value of 2.2. Okay, 2,100,000, right? Naira.
2,100,000,000 naira.
Okay, 100 million naira. Thank you, sir. Loan note B currently have a total market value of 400 million. The pre-tax cost of debt has been determined at 4.3% for loan note A and 4.1% for loan note B. After the unbinding, loan note B will be serviced by ZK Limited and loan note A will remain with Cola PLC. But the pre-tax cost of debt for both will increase by 0.3%. It is expected that ZK Limited will maintain its capital structure after the unbinding. MK Limited debt to equity ratio is estimated to be 40:60 in equivalent market value terms, and it has 1,200,000 shares in issue. The restaurant industry is dominated by Yanni PLC, a large listed company which owns many restaurants around the country. The average equity beta for restaurant industry is estimated at 1.38. The average debt equity ratio in the restaurant industry is 20:80. All companies pay corporate tax at a rate of 20% per year, and tax is payable in the same year as the profit is based on. The risk-free rate of return is estimated at 3%, and the market risk premium at 7.2%. The following estimated information will be applicable to ZK Limited if it is demerged. Colas PLC sales revenue is 4,500,000 currently, of which 20% is attributable to ZK Limited. It is estimated that after ZK is demerged, its annual sales revenue growth rate will be 6%, and the profit margin before interest and tax will be 21% of sales revenue. For each of the next 4 years, it can be assumed that the current tax allowable depreciation will remain equivalent to the amount of investment needed to maintain the current level of operations, but that ZK Limited will require an additional investment in asset of 0.25 naira for every 1 naira increase in sales revenue. After the initial 4 years, the annual growth rate of the company's free cash flow is expected to be 2.5% for the foreseeable future. The following estimated information applies to the acquisition of ZK Limited by MK Limited. If ZK Limited is acquired, the average price earning ratio, PE ratio for the hotel industry is 15.1. However, MK Limited PE ratio is estimated to be 10% lower than this. God abeg. We have extra from the current statement of profit or loss applicable to MK and ZK Limited as follows. We have PBIT, we have interest tax, then profit after tax, like we have the table there. After the acquisition, it is expected that the PE ratio of the combined business will be midpoint between the two individual companies' PE ratio. Between the individual companies' PE ratio, the annual after-tax profits will increase by 62 million naira due to combination of the two companies. MK Limited has proposed to pay for acquiring ZK Limited either through a cash offer of 0.66 naira for a MK Limited share or 1 MK Limited share for every 3 ZK Limited shares. MK Limited will borrow the money needed to pay the acquisition. You are required. Estimate the value of each ZK Limited share if it is demerged and listed as an independent company. Note, calculate to the nearest 1 million except per share date that should be done to 2 decimal places. B. Estimate 1. The additional equity value created when combining MK Limited and ZK Limited. 2B. The percentage gain to each of MK Limited and ZK Limited shareholders group under each payment method. BII, the impact of MK Limited capital structure under each payment method. Then we have C, evaluate the financial and other factors that both MK Limited shareholders and ZK Limited shareholders would consider prior to agreeing to the acquisition and the impact of MK Limited capital structure on under each payment method. 30
Uh,
marks.
th Thank you very much, Nike. As you can see, it is expected because this is a compulsory question. Now, on the day of your exam, whenever you are faced with a question like this, you don't need to panic because if you allow fear to take the best of you, certainly you can't do well in that question. Therefore, you need to, if possible, take a very deep breath and then review the question, read the question at once. As you are reading it, then try to underline the basic variables that you need to do justice to solving the question. And also, like we have been advising you from day one to date, whenever you are solving a question, please, whenever you are given your question paper on the day of your exam, don't always start with the compulsory, because if you start with the compulsory question, there is tendency for you to spend more than the required time on the compulsory question. Therefore, we always advise you that you should go for the smaller or cheapest questions. Go to section B and C. Review the three questions in section B. Review the three questions given to you in section C. Look at each of the questions. Which one do you think you can easily solve without sweating, right? Not only that, you can pocket like one or two because you are supposed to answer two questions in section B, two questions in section C, then compulsory question making 5 questions out of 7. Therefore, in section B, look at out of the 3 questions, do you have any two? Do you know any 2 questions you can easily solve within the next 1 hour? If yes, quickly go ahead and do it. Go to section C. Is there any 2 questions you can solve out of the 3 within the next 45 minutes, maximum 15 minutes, right? So if any, go there and solve it. Once you have pocketed like 3 to 4 questions, all right, then you can go ahead and balance on the compulsory question. Go and waste your time on the compulsory questions. Wasting time in the sense that you must understand the requirements. Because if you don't understand the requirements, you won't know the approach you are supposed to use to solve the question. Therefore, on the day of your exam, if you are given a question like this, the first thing first you need to don't read the body of the question. Go straight to the requirements. Just go straight. Any compulsory question you are given, in fact, whether compulsory or any question you are given, we're assuming that we're in the exam hall. This is an exam question that we want to solve. I'm a student, you are a student, we want to solve it. I want to show you the approach that you're supposed to use on the day of your exam. So the first thing first is for you to, once your exam invigilator tells you that, okay, you can start, then in that case, you have to review all the 7 questions given to you. As you are reviewing it, you need to just tick anyone you know that you are going to attempt. All right. So we now want to solve this compulsory question number 1. The first thing you are going to do before reading the body of the question is to check the requirements. What is examiner asking me to do? In this requirement number A, you are to estimate the value of each ZK Limited share if it is demerged and listed as an independent company. All right, so you want to determine the market value of ZK Limited after the spin-off. So if you unbundle ZK Limited from Cola Limited, what will be the market value of ZK? That's what you want to do. You want to calculate the market value of ZK. I will then go to the question, how do I estimate the market value of ZK? Of course, examiner has given you, the information will surely be there. It is not left for you to be able to identify what examiner has hidden for you to be able to solve it, to do justice to the question. Then, to solve this number A, we want to calculate market value. definitely we are going to use cash flow. All right, we are going to use cash flow. So how am I going to do this? In any case, we want to calculate the market value of ZK Limited. Then number B, I will come back to that one later. Then number B, you have to estimate additional equity value created when combining MK Limited and ZK Limited. Yes, you want to calculate additional equity value created. Like I explained to you in one of our previous classes, additional equity value created represent the difference between the post-acquisition market value and the pre-acquisition market value of the combined companies. All right. So if you know what to do, of course, all you need to do in this case, you are going to create about 3 steps. Step one is to calculate the pre-acquisition market value of individual company. What is the pre-acquisition market value of MK? What's the pre-acquisition market value of ZK? You add the two together, you keep it. That is the total pre-acquisition market value. Then you need to go ahead and calculate the additional, you need to calculate the post-acquisition market value. After combining MK and ZK Limited, what is the market value? That's the post-acquisition market value. So the third step is to calculate the additional equity value created, which is the difference between the post-acquisition market value and the pre-acquisition market value of the combined. You keep it on one side, you hang your 4 marks, then you move to the next one. You have to calculate the percentage gain to each of the MK's Limited and ZK's Limited shareholder group under each payment method. In the question, we have 2 payment methods. One is to pay cash, the other one is to pay through share exchange. All right. So what will be the gain to the shareholder of each company? Of course, you are going to estimate that too. Then number 3, you have to determine the impact of MK's Limited capital structure under each payment method. You know, anytime you are talking about capital structure, examiner is simply asking you for gearing. All right. You want to determine the gearing ratio after the business combination. When MK Limited acquires ZK Limited, what will be the impact on the gearing ratio? All right, that is the debt equity proportion, the post-acquisition debt equity proportion. That's what the examiner is asking you to do in that number 3. Then number C, you have to evaluate the financial and then other factors that both MK's Limited shareholder and ZK Limited shareholder will consider prior to agreeing to the acquisition, and then the impact of MK's Limited capital structure under each payment method. So that is basically the requirement. So the first one says we should estimate the value of each ZK Limited share if the company is demerged. So to solve this, first thing first, you need to go back to the question. And then after that, you need to bring out all the variables that you need. You need to bring out all the variables that you are going to open to the question at your end so that I can share my working notes. All right. So to solve this, you need to your first approach will be that all relevant information that you need to do justice to the question, to solving the question, you need to bring it out. As you are reading a paragraph by paragraph, so any relevant information that you have in the question, you need to bring it out. Okay? For color limit, for color PLC, what are the information on color given to us? On ZK Limited, what information are you given to solve the question? On MK Limited, what information do you have? Then what are the general information given in the question that does not relate to any of the company? All right. So when you bring out, because once you are able to bring out all relevant information, the question is as good as solved correctly. But if you don't know how to derive the relevant information that you need or how to apply, how to bring out all relevant information from the question, then you may likely struggle to solve the question. So without wasting more time on this, let's go back to solving the question. Please, I need you to open to the material at your end, and then another person will help us to read again so that I'll be able to, I want to show you how you are going to be doing it on the day of your exam. Yes, I need somebody to volunteer. Thank you once again, Nike. You really tried. Then I need another person to help us to read. Who
Color
is helping us?
PLC.
Okay,
Okay.
sir, I can.
Yeah, so I want to stop sharing this. I want to stop sharing. You can open at your hand so that I can move to the working note. I want to show you how we are going to be picking the information. All right. Okay. Uh, Now, to do justice to the question, because I know it will take time if I begin to solve everything from the beginning. So it will take time. So I have to take my pain yesterday to ensure that I have it done ready for you. Now, yes, I need somebody to read the question, please.
Okay, Color
Color PLC.
PLC is a large listed company involved in two business sectors. Its main business is in the production of food and drink for supermarkets and other large traders. It also owns a chain of restaurants nationwide. Color's board of directors think the company is undervalued and is of the opinion that it should focus on the rapid innovation taking place in the food and drink production sector. Therefore, Color's BOD has decided to unbundle the restaurant business into a company called ZK Limited, and Color PLC can either spin off or sell ZK Limited after the demerger so that Color PLC can focus on its remaining business of food and drink production. Initially,
Yes, hold on, Tolu, hold on. Now, when you look at the first paragraph, there is nothing much in the first paragraph. It's just introduction. So this is just a preamble. Examiner is giving you a preamble of what is to come. Now, in the second paragraph, the one that Tolu just read, you are told that the board of directors of Colors PLC has decided to unbundle they want to split the restaurant business into a company called ZK Limited. And Color will then, of course, the company will then focus on the food and drink production business. All right. So the bottom line is that there is a company called Color PLC. The company is involved in two different activities. One is production of food and drinks for supermarkets and other large traders. All right. The company also owns a restaurant. Therefore, the restaurant business is what the company wants to spin off from Color PLC so that they will create a separate entity known as ZK Limited. So when you say spin off is the same thing as demerger. All right. So move on from there. Initially, thank you for holding on.
Okay, sir. Initially, Color PLC shareholders will own ZK Limited on the basis of owning one ZK Limited share for every Color PLC share owned by them. MK Limited is a large unlisted company controlled by 20 shareholders who all have a significant stake in the business.
Hold on, Tolu. Now,
Yes.
in this last statement you just said in the second paragraph, you are told that initially, Colors PLC shareholders will own ZK Limited on the basis of owning one ZK Limited share for every Color shares owned by them. This means that Color PLC will own 100% of ZK Limited on the basis of the normal number of shares owned in Colors PLC. All right. So whatever the shares of Color PLC is the same thing you are going to, number of shares in Color PLC is the same thing you are going to have in the ZK Limited. So go to paragraph C. Thank you.
Okay. So, MK Limited owns a number of hotels around the country and is looking to diversify into the restaurant business. MK Limited has approached Color PLC about the possibility of purchasing ZK Limited. MK Limited will finance the purchase either through a cash-only offer or a share-for-share offer. If ZK Limited is demerged, it will be listed on the stock exchange as an independent company. Color PLC is unsure whether to sell ZK Limited to MK Limited or demerge it into an independent company. So we have our financial statement below. Color PLC shares are traded at 2 naira 45 kobo each and have a equity beta of 1.3. The part of the business.
Hold on from there. So let's bring out the information now. We have been given, remember, we want to determine the market value of ZK Limited. We are not calculating market value. We are not valuing Color PLC. What we want to value is ZK Limited after the merger. All right. Therefore, what information do you need? In this paragraph, you are told that Color PLC's shares are trading at 2 naira 45 kobo each. So that means we need to and have an equity beta of 1.3. The part of the business which will become ZK Limited account for 24.5% of Color PLC total equity value. Therefore, what do we need to do in this paragraph? First thing first, we need to determine the total equity value of Color PLC. Once you get the equity value of Color PLC, they will now multiply 24.5% as the share attributable to ZK Limited. That means the value of ZK Limited will be 24.5% of the value of Color PLC. So let us go and indicate that in our working note. All right. So now, like I said, in the question you are told that the equity value of Color PLC, the share price of Color PLC is 2 naira 45 kobo. Then we need to determine the number of shares of Color PLC because we are told in the question that ZK Limited has 24.5% in the total market value of equity of Color PLC. Now, to calculate the market value of equity of Color PLC, you already know the formula. Because in the question, you are not given number of shares. Therefore, to get number of shares, it will be share capital divided by nominal value. Share capital in the question is 1 billion naira as given to us. Then, nominal price per share is 50 kobo. When you divide 1 billion by 50 kobo, it will give you 2 billion shares. All right, we have 2 billion shares. Then, to now get the market value of Color, you need to multiply the 2 billion shares with the share price. Share price, according to the question, is 2 naira 45 kobo. When you multiply, that will be 4.9 billion naira. So the value of Color PLC, the market value of Color PLC ordinary shares is 4.9 billion naira. So we have identified that. Okay. Also, examiner now told you that, ZK Limited, we own 24.5% of the total market value of Color PLC. So to get the market value of equity or equity value of ZK, it will be 24.5% of the 4.9 billion naira that we have calculated. So this is how I got when you multiply 4,900 multiplied by 24.5, you are going to have 1,201,000,000 naira. Okay, so that is for that. We are done with that information. Then, what else in that paragraph? So go ahead, Tolu.
Okay. Color PLC loan notes A currently have a total market value of 2.1 billion. Loan notes B currently has a total market value of 400 million naira. The pre-tax cost of debt has been determined at 4.3% for loan note A and 4.1% for loan note B. After the unbundling, loan note B will be serviced by ZK Limited and loan note A will remain with Color PLC. But the pre-tax cost of debt for both will increase by 0.3%. It is expected that ZK Limited will maintain its capital structure after the unbundling.
Yes, hold on there. So let's interpret that scenario. You have been told in the question that Color PLC loan notes A currently have a total market value of 2.1 billion naira. Then loan note B is 400 million market value. So let us indicate that on our working note. So for the debt value, we are told that the market value of the loan note A is 2.1 billion naira. Loan note B, market value is 400 million naira. You're now told that each of them we have, let me go back. You are now told that each of the, but the pre-tax cost of debt, that is the interest rates for both will increase by 0.3%. Okay. So what that means is that our focus is on ZK Limited. We are told that ZK will take over after the unbundling. Loan note B will be serviced by ZK Limited and loan note A will remain with Collar PLC. So let's indicate that on our working note. You can see loan note taking over from Collar PLC is 400 million, and that's the market value of the loan note that ZK Limited will take over from Collar PLC. This loan note B, the interest rate of the loan note B is 4.1%. You are now told that after the unbundling, let me go back. But the pre-tax cost of debt for both will increase by 0.3%. So after the merger, then the pre-tax cost of debt, the interest rate will increase by 0.3%. Since ZK Limited is taking over only 400 loan note B of 400 million naira. So the interest rate we are going to charge on that loan note will be 4.1% plus additional interest of 0.3%. So that's what gave us the 4.4%. So if I want to determine interest rates, if I want to determine interest expense on this 400 million naira, 400 billion naira, 400 million. So it will be 4.4% of 400. Okay, so that is that. We have indicated that information. Then let's go back to the question, Tolu.
All right, sir. So MK Limited debt to equity ratio is estimated to be 40 to 60 in equivalent market value terms, and it has 1.2 billion shares in issue. The restaurant, okay, sir.
Hold on. So let's go back. Let us go and create a section, information on MK Limited. Now, examiner has mentioned MK Limited. What is examiner saying? Here is MK. You are told that the debt equity ratio in market value term of MK Limited is 40 to 60, which means that debt is 40, equity is 60. You are also given number of shares of MK Limited to be 1.2 billion shares. We are given 1.2 billion shares. Okay? Now, read on from there.
Okay, sir. The restaurant industry is dominated by Yanni PLC, a large listed company which owns many restaurants around the country. The average equity beta for the restaurant industry is estimated at 1.38. The average debt.
Hold on. So at that point, you are told that the average equity beta of restaurants industry is 1.38. So you need to indicate that. You need to bring it out or you underline it in the question so that you don't forget it. Because once the examiner is giving you equity beta, debt beta, whatever, you should know that you are going to calculate cost of capital. Once you are given equity beta, you are given debt beta, you should know that examiner is telling you, is working towards something that you are going to calculate cost of capital for the purpose. You remember, when you want to value a company, it is your cash flow using discounted by the appropriate cost of capital. So you must know what to do next. Read on from there.
Okay. The average debt equity ratio in the restaurant industry is 20 to 80. All companies.
Hold on. Debt equity proportion in the restaurant industry. The debt equity proportion in the restaurant industry is average 20 to 80, which means that debt is 20, equity is 80. Read on.
Okay, sir. Okay, yes. The all companies pay corporate tax at a rate of 20% per year, and tax is payable in this. Okay.
Yeah.
And tax
So
is
that is general information because
yeah.
we are told that all the companies pay tax at the rate of 20%. That is general information. So we have indicated tax. Read on.
Okay, sir. Okay, in the same year, as the profit is based on, the risk-free rate of return is estimated at 3% and the market risk premium at 7.2%.
Yes, hold on. So again, generally, examiner has given us risk-free rate of return to be 3%, market risk premium to be 7.2%. These are general information which tell you that anytime you want to calculate cost of equity, examiner has shown you remember when you want to calculate a WACC, when you want to calculate market weighted average cost of capital, you calculate cost of equity, you calculate cost of debt, then you calculate weighted average cost of capital. So in this question, examiner has demonstrated for you the information, how you are going to calculate your cost of equity, which means the examiner wants you to use capital asset pricing model. So because you have been given risk-free rate of return to be 3%, you have been given market risk premium to be 7.2. You know that there is no other method that use that information other than capital asset pricing model. All right. So as you are reading the question, you need to know what next you should look out for in the question. Move on from there, Tolu.
Okay, sir. Okay, the following estimated information will be applicable to ZK Limited if it is demerged. Collar PLC sales revenue is 4.5 billion naira currently, of which 20% is attributable to ZK Limited.
Hold on from there. So let's take it bit by bit. Examiner has told us in the question that the sales revenue of Collar PLC is 4.5 billion naira, out of which 20% is attributable to ZK Limited. Therefore, you multiply 20% of 4,500, we have 900. So 900 million is the sales revenue of the current sales revenue of ZK Limited is 900 million. Read on from there, Tolu.
Okay, sir. So, okay, it is estimated that after ZK Limited is demerged, its annual sales revenue growth rate will be 6%, and the profit margin. Okay.
Hold on from there. Examiner has told you that this 900 million naira sales revenue for ZK Limited is the current sales revenue. You are now told that after the company is demerged, then the annual sales growth rate after the merger will be 6%, which means that you need to grow the current value of 900. You need to grow it by 6% for the next 4 years. Read on from there.
Okay, sir. 6%, and the profit margin before interest and tax will be 21% of sales revenue.
Okay, hold on from there. So your profit before interest and tax, according to the question, is 21% of the sales revenue, of annual sales revenue. So there are two different ways you can do this. It is either you multiply, since your profit before interest and tax is 21% of the sales revenue, you know that sales revenue is 900 million. 21% of 900 million will give you 189 million. You can follow that route so that going forward to the current profit before interest and tax is 189 million. You say if I now want to calculate for the next 4 years, it will be 1.06 multiplied by 189. So it will give me the annual profit before interest and tax for the next 4 years. If I don't want to follow that route, I will start from the sales revenue. The sales revenue is now, the current sales revenue is 900 million. So we are told it will grow by 6%. Therefore, 1.06 multiplied by 900 will give me for year 1, multiplied by 1.06 will give me for year 2, multiplied by 1.06 will give me for year 3, and then I will do for year 4. I can follow, so and I have options for me to be able to solve that. So I will show you the one I use later on. Go ahead, Tolu.
Okay, sir. So, in continuation, for each of, it can be assumed that the current tax allowable depreciation will remain equivalent to the amount of investment added to maintain the current level of operation, but that ZK Limited will require an additional investment in assets of 0.25 naira for every 1 naira increase in sales revenue.
Yes. So we are told that for every 1 naira increase in sales value, there will be additional investment to maintain the operation of the business of 25 kobo. So if your sales increase by 1 naira, then there's an additional investment. You can call it either additional investment or you call it working capital. All right. So that will be 0.25 of every 1 naira increase in sales. So how do you do this? How do you trade this? The first thing you need to do, you need to determine increment in sales. If the current sales value is 900, you now grow it by 6%. To get for year 2, you get for year 3, you get for year 4. So you now see the trend. You find the increment from 900 to from the current value of 900 to sales of year 1. You find the difference. You multiply by 0.25. From year 1 to year 2 sales value, what is the increment? Then the difference, you multiply by 0.2. That's how you are going to find the additional investments required to maintain the operation. So read on, Tolu. I will show you later on.
Okay. After the initial 4 years, the annual growth rate of the company free cash flow is expected to be 2.5% for the foreseeable future.
Okay, so remember, in my previous classes, I explained to you that when you are carrying out a valuation, when you are valuing a business, there will be 2 stages of your valuation, especially if you are using cash flow for the purpose of the valuation. The initial stage, the initial period is from, like in this case, initial period is 4 years, right? Then you need to calculate the terminal value, that is the present value after the initial period. So from year 5 to infinity, examiner has told you to use a growth rate of 2.5%. So that's what we are going to use. Move on from there, Tolu.
Okay, sir. The following information, estimated information applies to the acquisition of ZK Limited by MK Limited. If ZK Limited is acquired, the average price earning ratio for the hotel industry is 15.61. However,
Right.
MK Limited PE ratio is estimated to be 10% lower than this.
Okay, hold on from there. Thank you. So you are told that average industry PE ratio is 15.61 times. Okay. You are now told that if MK Limited P ratio, let me go back to the question so that I can be speaking directly from the information given to us. Or Tolu, repeat the last statement there.
Okay, sir.
The average.
Okay, the average price earning ratio for the hotel industry is 15.61. However, MK Limited PE ratio is estimated to be 10% lower than this.
So that means the PE ratio, remember, because MK Limited is a limited liability company, it doesn't have PE ratio. Remember what I told when I was explaining the concept under valuation. An unquoted company does not have a PE ratio. You need to borrow the PE ratio of a listed comparable company operating in the same industry. And then you are not going to use the exact PE ratio of a quoted company for an unquoted company. Because once you do that, that means you are assuming that both the quoted and unquoted company have similar risk, which is not true. Because an unlisted company is more risky relative to a quoted company. And that's what the examiner is telling you here, that you should adjust the average industry PE ratio of 15.61 to 90%. So should be 15.61 less 10%. So 10%, when you minus 10% from 100, that means you are supposed to account for 90% of the PE ratio of the industry PE ratio. In this case, we have the PE ratio of MK Limited to be 14.05. Read on from there, Tolu.
Okay, sir. All right. So we are giving the abstract for the current statement of profit or loss. It now says that after the acquisition, it is expected.
Go ahead.
Okay, after the acquisition, it is expected that the PE ratio of the combined company will be midpoints between the two individual PE ratios.
Hold
The
on there,
annual,
Tolu.
okay, sir.
Hold on. Examiner has told you here that this is where you have information after the acquisition, after MK Limited acquire ZK Limited. This is where you are going to have what you are going to do for calculating your post-acquisition market value. This is where you have the information. Anywhere in the question that the examiner has mentioned, has given information about the events after the acquisition, then that is where you are going to, that is how you are going to calculate your post-acquisition market value. So the examiner is telling you there that after the acquisition, it is expected that the PE ratio of combined company would be midpoint of the two individuals' company PE ratio. What that means is that you need to calculate what is the PE ratio of MK Limited, what is the PE ratio of ZK Limited. All right. So once you have the two, you divide it by two. That will give you the average. All right. So now let's go. Let me. How do you then treat? How did I treat it? Let's go down a little bit more. Let me know. The P ratio. I want to show where I have the average. All right. I think I indicated this somewhere else. Okay. Read on, Tolu. Read
Okay,
on,
sir.
Tolu.
All right. Okay. The annual average after tax profit will increase by 62 million naira due to the combination of the two companies.
Okay,
MK,
so
okay,
hold on. How do you treat this information? Examiner has told you that the annual after-tax profits will increase by 62 million naira due to combination of the two companies. You can say this 62 million naira represents synergy. So when you combine the two when you combine the two companies, it is expected to generate additional profit of 62 million naira. So the profit after tax of MK Limited from the table given to us is 171 billion naira. Then ZK Limited profit after tax is 117 billion 100 million 1 million naira, 100 million naira. So that's the information you are given there. All right. So then it will be 171 plus 117.1 plus 62. That will give us the profits after the business, the total profit after the business combination. You had the three of them together. So let's move on from there. Tolu,
okay, sir.
I will show
Um,
you later on how we treated that. Yeah,
okay.
go ahead.
MK Limited has proposed to pay for acquiring ZK Limited either through a cash offer of 66 kobo for a ZK Limited share or one MK Limited share for every three ZK Limited shares. MK
Okay,
Limited, okay,
go ahead.
okay, MK Limited will borrow the money needed to pay for the acquisition.
Now, this paragraph is saying that MK Limited has proposed to pay for acquiring ZK Limited either through a cash offer of 66 kobo for a share limit for a ZK Limited share or one MK Limited share for every three ZK Limited share. Now, how do you treat this? Examiner is showing you the method of payment. All right. After the acquisition, after MK Limited acquires ZK Limited, MK Limited can either pay cash of 66 kobo per share, or the company can offer 1 for 3. That is 1 over
Number
3 of the shares of ZK Limited. Now, finally, you are told that MK Limited will borrow the money needed to pay for the acquisition. So if the company is paying cash, if the company is paying cash of 66 kobo per share to acquire ZK Limited, the company does not have the money. Therefore, the company will go and borrow the money needed for the acquisition. So the company will borrow money to pay for the acquisition of ZK Limited. That means the gearing will increase because when you borrow, your gearing level will increase. All right. So this is the information given in the question. Let's now go ahead and solve. So the first requirement says we should calculate you should estimate the value of ZK Limited after demerge, 12 months. So without wasting time on this, how do we calculate the market value of ZK Limited after demerge? The first thing first you need to do is to calculate free cash flow. You calculate free cash flow to the firm for ZK Limited. How do you determine free cash flow to the firm? First thing first, examiner has told you in the question that based on the analysis we have done so far, the sales revenue of ZK Limited is 900 million naira. 900 million naira is the sales revenue of ZK Limited. So, and we are now told that this sales revenue will increase by 6% per annum. This 900 million naira is the current revenue. That is the current revenue. It's stated in current terms. Therefore, we are now told that it will grow by 6%. So let us go and calculate that. 900 million multiplied by 1.06. What do we have? Bring out your calculator. Let's do it together. I don't want to show you just calculate the prepared solution. Let's treat it together. Bring out your calculator, everyone. Then Tolu, you are the one that will be giving me the numbers.
Okay,
so,
sir.
The sales revenue, the current sales revenue is 900 million naira. So we are told that it will grow by 6% for the next 4 years. Therefore, 1.06 multiplied by 900, what do you have in your calculator?
954.
Multiply by 1.06.
1011.
So whatever you have in your calculator, multiply by 1.06.
1072.
Multiply by 1.06.
1136.
So we have grown the revenue. That is sorted out. Remember, we are calculating free cash flow to the firm. Now, from this revenue, examiner now told us that, okay, the profit before interest and tax will be 21% of the sales. So all we need to do is to now multiply 21% of 954. What do you get?
Okay, sir, come
here. 954 multiplied by 0.21.
200.
200.
Yes,
Then
200.
again, 21% of 1011.
That's 212.
21% of 1072.
That's 225.
21% of 1136.
239.
So that is how we got the profit before interest and tax. The next item would then be the tax. We need to pay tax on the profit before. Remember, this profit before interest and tax is meant for both debt holders and equity holders. So you are not going to charge any interest. The next thing would be to calculate tax. So how much is tax? You are told that tax is 20%. So what's 20% of 400? Sorry, of 200?
Okay.
40.
40.
So that's how we got this 40. And we are told that tax is paid in the year profit is earned. So what's 20% of 212?
42.
20% of 225. Let's move faster.
45.
20% of 239 from your calculator.
Yes. 48. Yeah, 48.
48. So that's how we got the tax rates. I mean, the tax liability. Now, remember, we are calculating free cash flow to the firm first. You know, from our format, we have profit before interest and tax. You charge tax. You add back non-cash item, which is depreciation. In this question, we don't have depreciation, so we ignore that information. Then you consider changes in working capital. Then we also consider additional capital expenditure. All right. So that will give us the free cash flow to the firm. So in the question, we don't have depreciation, no amortization, no provision. So we ignore that information. Again, in the question, the examiner has told us that there will be need for additional investments of 25 naira, of 25 kobo for every 1 naira increase in sales. For every 1 naira increase in sales, the company will incur additional investment of 25 kobo. So if that is the case, I will then go back to the question. I will go back to the question. Then what will be the, I need to first of all find the incremental sales. Since examiner has told me that working capital will increase by, working capital will be 25 kobo for every 1 naira increase in sales. Therefore, I need to first of all determine the incremental sales. How do I get my incremental sales? Currently, sales value is 900 million naira. That is the current value of the sales. In year one, it has increased to 954. Therefore, 954 minus 900 will give us 54. 954 minus 1011 will give us 57. 1011 minus 1072 will give us increase of 61. 1072 minus 1136 will give us increase of 64. That is how we got the incremental sales. Now, since you are told that working capital is 25 kobo of every 1 naira increase in sales, in year one, sales value has increased by 54 million. Therefore, what is 0.25 of 54? What do you have?
0.25.
14. Okay,
14,
0.25 multiplied by 57.
14.25. 14.
14?
Yes, sir.
Yeah.
Yes.
So 0.25 multiplied by 61 for year three.
15.25. 15.
Then 15. Then 0.25 multiplied by 64.
16.
That's it.
16. So that's how we got the additional investment, or we call it working capital. All right, that's how we got it. So since there is
Sorry,
no
Mr.
other,
Adejo, I want
yes,
to draw your attention to. Okay, I understand. I wanted to know how you got the incremental sales. I understand for year two. It's 1,000 minus 95, I guess.
yeah.
Okay, no.
Okay, so now that we have, the next thing we need to do now is to determine the free cash flow to the firm. For year one, 200 minus 40 minus 14 will give us 146. In year two, 212 minus 42 minus 14 will give us 156. In year three, 225 minus 45 minus 15 will give us 165. For year four, 239 minus 48 minus 16 will give us 175. So that will give us the free cash flow to the firm. Now that you have the free cash flow to the firm, we need to discount it at the appropriate cost of capital. I will then go back to the question, how am I going to calculate my cost of capital? Okay, so examiner has given us information on how to estimate the cost of capital. In the question, you are given information on capping, you are given risk-free rate of return, you are given market risk premium, and also you are given the debt value and all of that. So in this case, we need to go ahead and estimate our cost of capital. So to calculate the cost of capital, we need to first of all calculate cost of equity, we calculate cost of debt, then you now calculate weighted average cost of capital. So let's go ahead and determine that. Let's go and do working for our cost of capital. This is where I have the working. Okay. Now, calculating cost of capital. Now we want to, like I said, we want to discount the free cash flow to the firm using the appropriate cost of capital. Based on the information given in the question, we want to calculate cost of capital WACC for ZK Limited. We want to calculate the current WACC of ZK Limited. So to do this, we are told in the question that ZK Limited does not have a beta it does not have a beta in the restaurant industry. On the information we have noted above, the average beta, the average equity beta in the industry is 1.38. That's what we have identified. Therefore, we have identified the average industry beta to be 1.38. The next, remember, when you want to calculate WACC, what do you do? In this case, you need to first of all to calculate your cost of equity using capping. Since you are not given the beta of ZK Limited, so you use the industry beta of 1.38. This 1.38, you are also given the industry gearing ratio to be 20:80. That means this 1.38 is geared. If the 1.38 is geared, then you need to ungear it, and then move to step 2 to ungear. Also in the question, you are not given debt beta of the industry. You are not given debt beta in the restaurant industry. Therefore, debt beta is assumed to be risk-free. It is assumed to be risk-free. So if that is the case, to ungear, you know the formula to use. This is our formula. That's what we will be using from day one. All right. BA is the asset beta. BEG is beta equity of a gear company. Then E is the equity value. D is the debt value. Then T is the tax rate. So to do this, of course, beta equity of a gear is 1.38. We are told in the question that the average debt equity proportion in the restaurant industry is 20:80, which means that debt is 20% of the market value, then equity is 80%. So E is equity, which is 80, divided by 80 plus debt. Debt is 20%. 1 minus tax rate will give us, tax rate is 20%. So 1 minus 20% will give us 80%. When you put it in your calculator, start from the numerator, so from the denominator, 0.8 multiplied by 20, all right, plus 80 equal 80 divided by answer equal multiplied by 1.38. This will give us 1.15. The asset beta of restaurant industry is 1.15. This is the beta that measures the risk associated with restaurant industry. Now that we have the risk that's associated with restaurant industry, we need to move to step 3. Step 3 says you should regear to incorporate the financial risk of ZK Limited. So again, we are not given debt beta of ZK. Therefore, this is the formula we are going to use. Let me put it down. Since we are not given, let me go down a little bit. Since debt beta of ZK Limited is not given, it is assumed to be risk-free. Because if in the question you are given debt beta of ZK, that means you need to repeat. You need to use the combined formula as we did in some of our previous classes. All right. So that is for that. So since it is risk-free, that's why therefore the formula below will be used to ungear. Let me put it. Therefore, the formula below will be used to ungear. So you're already familiar with it, so no shaking. Let's move on from here. So to regear, I will then go to the question. I don't know the debt equity proportion of ZK Limited, but we've already calculated the debt value of ZK Limited. We are told that ZK Limited will take over the loan note B, which is 400 million naira. And we have already calculated the equity value of ZK Limited to be 1,201 million. Okay, let me go back to our initial page. Under ZK, you remember based on our initial information that we have identified, the equity value of ZK Limited is 1201, 1,201 million. That is 1.2 billion naira. That's the equity value of CK. Then the debt value of CK, the examiner told you that the loan note B will be taken over from caller by ZK Limited. and the value, the market value of that loan note is 400 million naira. So equity value is 1201, debt value is 400. So that will be the current debt equity proportion of ZK Limited. So let's go back to calculating our cost of capital. All right, so this is the information here. The debt value is 400 for ZK, equity value is 1201 for ZK. So you now put it in the formula of to regear. So the final answer is 1.46. So the beta equity of a gear is 1.46. How? 400 divided by 1201 equal, multiplied by 0.08 equal, plus 1 equal, multiplied by 1.15. So that will give us 1.46. Now that you have the beta equity of a gear, step 4 says you should calculate cost of equity. I would then ask myself, which method are you using to calculate cost of equity? Of course, certainly you are using capping, capital asset pricing model. So this is the formula for calculating capital asset pricing model. Cost of equity equal to risk-free rate of return plus beta multiplied by market risk premium. All right. Therefore, the risk-free rate of return based on the general information we have identified in the question is 3%. We have calculated beta equity of a gear to be 1.46. The risk premium given in the question, the difference between market return, RM, and the risk-free rate of return, RF, is the risk premium. An examiner has given a risk premium of 7.2%. Therefore, 7.2 multiplied by 1.6 equal, plus 3 equal. That will give us 13.51. Cost of equity using capping is 13.51. So the next thing I need to do is to determine cost of debt. I need to determine cost of debt. This 400 million naira loan note B, the value of the 400 million naira loan note B, we are told that the interest rate is 4.1%. The interest rate of that loan note B is 4.1%. We are now told that this will increase by 0.3%. Therefore, to now determine the cost of equity, if I like, I can go and calculate after-tax cost of debt. If I like, I can say after-tax cost of debt, post-tax. If I want to follow this route, I will calculate separately post-tax cost of debt. Okay, to do this, you know that this is equal to interest multiplied by 1 minus tax. All right, so I would then say interest is 4.4, 1 minus tax. Tax rate is 20%, so we are supposed to account for 80%. So what do you have here? That will be 4.4, 4.4 multiplied by 0.8. So we have 3.52.
3.52.
So here is the 3.52. So since I've done 3.52, I don't need to come and put 1 minus tax here again if I want to follow that route, right? But again, since this is a very straightforward line item, so I don't need to go and be doing this again. It's a waste of time. So I'll just put it in my WACC formula, all right? So to calculate WACC, you know this formula already. Equity divided by total value, that is equity over equity plus debt, multiplied by cost of equity plus debt value divided by equity plus debt multiplied by after-tax cost of debt. So the market value of equity is 1201, 1,201. The total market value, remember, market value of equity. Let me show you. I think I have it up here. Let me go back there. Market value of equity. Yeah, market value of debt is 400. Market value of equity is 1201. When you add the two together, this will give you 1601 million. That's the total market value. So to now get my WACC, I will just say 1201 divided by total value multiplied by the cost of equity we have calculated to be 13.51. Okay, that will give me 10.13%. On the other side, the value of the debt is 400 million divided by total value of 1601, then multiplied by after tax cost of debt. Of course, in this case, I use post-tax, so which is 4.4, then multiply by 0.8 to get the after-tax. Then I got 0.88. When you add the two together, the WACC of ZK Limited is approximately 11%. The WACC of ZK is approximately 11%. Now that you have the WACC, you then go back to your free cash flow to the firm to go and calculate your present value. Please, if you have any question, always raise your hand so that I can provide clarification before we go too far. So we need to go back to our free cash flow to the firm. All right. So this is, you can see we left this for the past 5 minutes or thereabout because the cost of capital we are looking for, we don't have it. So we need to go and estimate the WACC. Now that we have calculated the WACC to be 11%, discount factor for year one at 11% will give you 0.901. Discount factor for year two at 11% is 0.82. Year three will be 0.731 and year four will be 0.659. So to now get the present value of each year, so to be the free cash flow to the firm multiplied by the discount factor. Therefore, what do we have here? 146 multiplied by 0.901 will give us 132. 156 multiplied by 0.812 will give us 127. 165 multiplied by 0.731 will give us 121. Then 175 multiplied by 0.659 will give us 115. So we have calculated the present value. This is not what the examiner is asking you to do. You are to determine the market value of ZK Limited after the merger. All right. So to do that, we're in the process of determining the market value. So now that we have determined the present value, so we need to get, remember, I told you that anytime you are valuing a company using cash flow, there will be two stages of your valuation. You calculate present value for the initial period. You also calculate present value to infinity. All right. After initial period to infinity. So the present value of the initial period, which is the 4 years. So the first year present value is 132 plus the second year cash flow present value of 127 plus 121 plus 115. We have total of 494. So the total present value for year one, from year 1 to 4, is 494 million naira. So we then need to calculate the present value from year 5. After year 4 is year 5. So from year 5 to infinity, we need to calculate present value after year 5, from year 5 to infinity. To do this, it will be the free cash flow of the base year multiplied by 1 plus the growth rate divided by the weighted average cost of capital minus the growth rate, all multiplied by discount factor of the base year. You're already familiar with it. We have done it severally in the previously. Now, the free cash flow to the firm of the base year. The base year is year 4. Free cash flow of year 4 is 175. This is the 175 you have here. That's the free cash flow of year 4. Then we are told that the growth rate after year 4 is 2.5%. Therefore, 175 multiplied by 1.025 divided by the WACC of 11% minus the growth rate of 2.5. So we got then multiplied by discount factor of the base year, which is 0.659. So when you multiply everything, you are going to have 1391. You have 1391. So to now get the corporate value, the total market value of ZK Limited, market value of equity of ZK Limited, you add everything together, then you have 1,885 million naira. So the current market value of ZK Limited is 1,885 million naira. Again, this is not what examiner, let me go back to the requirements. You have to estimate the value. Okay, you have to estimate the value of ZK Limited if it is demand. So that is, then your answer should be rounded to the nearest 1 million naira. So now that we have computed, yes, Damilola, talk to me. What's your question?
Sir, the PV from year 1 to year 4 is 495.
495. Okay. If you had 132 plus 127 plus 121 plus 115, you say it's the 495, right?
Yes, sir.
Yes, sir.
Okay. Okay. So let me correct this then. So this will be 195. So 195 plus that will give us 86. All right. Good. Now, examiner is now asking you, this 1885 is the value. Let me go back to the question again so that we know. Yes. So we have calculated, we have done for A. We are done for A. You only have to estimate the value of each of ZK Limited. You want to determine the market value of ZK Limited, and that's what we have done. So let me know before I move to B. Quickly, let me know if you have any question for that A so that we move to B quickly. Yes? Okay, so in the absence of no question. Now, before we move to B, we have not completed the A. This now, before we move to B,
I have, please, can you take it back to where you solved for BA?
please always raise your hand.
I don't know, I'm trying to navigate the button here. I can't see it. That's why I had to unmute. Sorry about that.
So I should do what? What
Can
do you
you
say I
take
should
it back
do?
to where you solved BA?
BA, we're still on A. Let me.
No, I mean where you solved, where you were solving for WAC, where you solved the better asset.
Okay, the workings. Yeah.
Yes, please. But where you
So
solved
don't worry, I will
the
still
better
share
asset.
asset beta. So I will still share the notes with you. No worries.
Okay.
Is it this place? Sarah,
Yes,
is it
yes,
this place?
yes.
Don't worry.
I just wanted to check
Okay,
something. 20 plus
it's all right.
80 plus 20.
Immediately after the class, I will share the notes.
Okay, thank you.
All right. Now, to complete the A requirements, you have calculated total market value. Yes, Somto, talk to me. Go ahead, Somto. Somto, you raise hand.
Okay,
Okay, I
yes.
think you put it down.
So the working capital is additional investment, right?
Yes.
Okay, thank you, sir.
Is that your question?
Yeah.
Okay. So, to complete the A requirements, examiner is asking you to determine the market value of ZK Limited. All right. So we have calculated total market value. All right. So remember, examiner said estimate the value of each ZK Limited share if it's demand. So you want to calculate market value of equity. Now, this 1,886 million value that you have determined, that is the total value, that is the corporate value. So to now get the equity value, you need to less the difference between corporate value and equity value will give you the difference between corporate value or enterprise value and the debt value we give you, asking it to calculate is the value of CK limit, calculate the market value of equity. So to do this, after you have determined the corporate value of 1,886 million, that is 1.886 billion, then of course, let me correct this, since our figure is 186, then this should be 9. Okay. Now, after this, you need to determine the corporate value, which is the total present value is 1,886, right? Then you need to determine the debt value. What is the debt portion of this total value? I will then carry my calculator, 186 multiplied by 0.2, because we are told in the question that the average debt equity ratio in the restaurant industry is 20%. So average debt equity ratio is 20 to 80. So debt is 20, equity will be 80. Therefore, to get the equity value, to get the debt value, I will say 20% of 1,886. So that's what gave us 377.2. So you round it. This is 6. So we get 377. When you minus it, the equity value, market value of equity is 1509. That is the total market value of equity. Remember, examiner say you should calculate share, the value of each value per share. Examiner says you should calculate value per share. So what that means is that after you have determined the total equity value of 1,509 million, you need to divide it by the number of shares. Okay, you need to divide it by the number of shares. What is the number of shares? Examiner in the ZK Limited, examiner told you that the number of shares in Collar PLC is the same as number of shares in the ZK Limited. Therefore, what is the number of shares in the ZK Limited? We have 1 billion. We have divided it by 0.5 to have 2 million shares. So number of shares in ZK Limited is 2 million shares. The total market value is 1,509. Let me change this one to 509. All right. So divided by 2,000. Let me recalculate it. 1,509 divided by 2,000. That's 0.75. It's still correct. So 0.75 is the value per share. The value per share is 0.75. Now, you want to know whether there is a gain from this. If you list, if you demerger, if the company, if Collar PLC demerge ZK Limited from the restaurant business and list it, of course, the company value per share will be 0.75. So you need to know whether there's going to be any gain from that demerger. All right. You want to know whether there's going to be any gain. To determine the gain will be the difference between the current current value per share, which is, of course, since the value of ZK Limited is 1201, number of shares is 200. So the current value is 0.60, that is 60 kobo. So the difference between the market value of equity that we have calculated now per share, all right, and then the current per value is 0.6. Of course, the difference is 15 kobo. So which means that the company is going to, every shareholders will gain 15 kobo for every one share held in ZK Limited. So if you want to determine the total percent, if you want to determine the percentage gain, then it will be 15, the gain of 15 divided by the old value, which is the current value of 60 kobo. So we have 25%. So that answers number A. We then move to number B. The reason why you have to determine the gain is because examiner wants you to determine value per share. This gain that I introduced is an additional effort. Examiner has you to determine value per share. You have to estimate the value of each ZK Limited share if it demerged and listed as an independent company. Okay, so that is for that. So you want to know whether you are going to make a gain, you are going to make profits from demerging ZK Limited. To do this, of course, we have seen that there will be a gain of 25%. So that answers number A. Let's quickly go to number B. Now, in the B part of the question, we have three requirements under B. The first one is to estimate the additional equity value created when combining MK Limited and ZK Limited. Now you want to combine MK and ZK. Therefore, what are you supposed to do? Sir, why did we use the average debt to equity ratio for ZK Limited? Yes, examiner has told you in the question that they have in the restaurant industry. In the restaurant industry, the average debt equity ratio is 20 to 80. So you don't have debt equity ratio of, that's what examiner asked you to use. And that's what we have used. When you go back to the question, you see the information there. Now, in the B1, examiner wants you to calculate additional equity value created when combining MK and ZK Limited. To do this, there are three steps. You want to determine additional equity value created. There are three steps you are going to carry out. The first step is to calculate the market value of MK and ZK before the acquisition. That is the pre-acquisition market value. Step 2, you need to calculate post-acquisition market value after combining MK and ZK. That's step 2. Then step 3, you then calculate additional equity value created. The additional equity value created will then be the difference between the post-acquisition market value and the pre-acquisition market value of the combined companies. Okay, so quickly, let's go through this. The time is fast spent. I can imagine. Only one question since. All right, so first thing first, let's calculate the pre-acquisition market value of MK and ZK. So for MK, I will then go to the question, how am I going to calculate the market value of MK Limited? When you go back to the question, the examiner has shown you how you are going to calculate the market value of MK. According to the question, let's go back to where we have information on MK, where the examiner mentioned, yes, you are told that there's a place where examiner, I'm going back to the to the question. Yes, where is the, let me start from
Is
the
in
beginning.
the second picture you sent, the average P ratio.
So I want to, yes, you are told that MK Limited debt to equity ratio is estimated to be 40 to 60, right? In equivalent market terms. Yes, that's the information I'm looking for. The debt equity ratio of MK's limited debt, of MK Limited is 40 to 60. All right. Then you are given number of shares. This 40 to 60 examiner told you is in market value terms. Therefore, what that means is that once I get the market value of MK Limited, 40% will be for debt, 60% will be for equity. Then number of shares of MK Limited in that same paragraph is 1,200 million shares in issue. Okay. How then am I going to calculate the market value of MK? So examiner also told us that MK has a PE ratio. There's a place where the examiner told us MK has a PE. Yes, I've seen it. You are told that the average price earning ratio for the hotel industry is 15.61. However, MK's limited PE ratio is assumed to be 10% lower than this, which means that examiner wants you to use PE ratio for the purpose of valuing MK Limited. So if I want to value a business using PE ratio, you remember, I've already explained earlier today, MK Limited is an unquoted company, which means that MK Limited will not have price earning ratio. But examiner has given you price earning ratio of the industry, of restaurant industry, to be 15.61. And we have using, and you are now told that for the purpose of value MKO, the PE ratio of the industry will reduce by 10%, which means that we are supposed to take 90%. So we have calculated the 90% of the PE ratio and we arrived at 14.05 for MK. And you know that when you are valuing a business using PE ratio, it is price earning ratio multiplied by profit after tax or earnings. So the P ratio is 14.05. The profit after tax of MK, based on the information given in the question from that table, is 171.0. That's the market value, that's the profit after tax of MK. All right. So when you multiply with the P ratio, we have total market value of 2,403 million. So the current market value of MK Limited is 2.4 billion naira. With this, we have determined the market value, the pre-acquisition market value of MK. Next is to calculate the pre-acquisition market value of ZK Limited. We have done that already. The market value of ZK Limited is out of the market value of Colors PLC. We are told that 24.5% represents is attributable to ZK Limited. We have calculated this before, which is 1,200.5. When you round it, that will be 1,201. Okay, 1,201. So that's the market value of ZK Limited. To now get the total pre-acquisition market value, you then add up the market value of ZK plus market value of MK. Add the two together, it will give us 3,604 million. 3,604 million. This is total pre-acquisition market value. So we then need to go and calculate step 2 now, is to calculate the post-acquisition market value. After MK and ZK Limited combined together, what will be their market value? You then go back to the question. We've already identified the information. You are told in the question that after the acquisition, it is expected that the P ratio of the combined company will be midpoint, that is average, between the two individual P ratio. So if that is the case, I need to determine what is the P ratio of MK. The P ratio of MK is 14.05. I don't know the P ratio of ZK Limited. So now I need to go and calculate the P ratio of ZK Limited. Let me see. I think I work it out somewhere. Let me go back. I think, yes, I've done it. So the P ratio of ZK Limited will be, whenever you want to, when you say P ratio, PE ratio is equal to share price over earnings per share. We have done this before. Now, in this question, since we don't have par value, we don't have per share information, so we are using total. So the share price is simply represent the total market value. This is the total market value. The earnings per share is the profit after tax. So that is what we have done. This is the formula you are going to use to get your PE ratio. Market value divided by profit after tax. So the market value of ZK Limited is 1,201. This is what you have in the under ZK Limited. This is the first thing you have here, 1,201 divided by the profit after tax of ZK Limited, based on the table given to us, is 117.1. Okay, then when you divide, this will give you 10.26. We have 10.26. So the price earning ratio of ZK Limited is 10.26. Now that you have the price earning ratio of ZK and the MK, then you need to go and value. You need to go and value. So here it is 10.26. All right. So examiner is saying that you should use is a midpoint of the P ratio of the two companies. So you add it together. The P ratio of ZK, the P ratio of MK, you add it together, you divide it by 2. So that will give you 24.31 divided by 2. We have average of 12.16. So the average P ratio, the average post-acquisition P ratio is 12.16. So I also need to have determined, remember, that means examiner wants you to, after the acquisition, after the two of them combine together, examiner wants you to value it using PE ratio. Examiner wants you to carry out your valuation using PE ratio. So we have determined the post-acquisition average PE ratio to be 12.16. We also need to determine the post-acquisition profit after tax. We need to determine the post-acquisition profit after tax. So to do this, I will take the profit after tax of PAT. In the question, let's go back to the question. You are told that the annual after-tax profits will increase by 62 million due to combination of the companies. That means there will be synergy. Therefore, I will pick the profit after tax of MK of 171 plus profit after tax of ZK of 117.1 plus the synergy of 62. All right, plus synergy of 62. That is what produced the profit after tax, post-acquisition profit after tax of 350.1 million, 350.1 billion rather. Okay, so that is what we have there. That's million rather. So now that we have the post-acquisition price earning ratio, we also have post-acquisition profit after tax. We can then calculate the post-acquisition market value of the combined. Of course, this is the formula. PE ratio multiplied by earnings. The PE ratio is 12.16. Total earnings is 350.1. When you multiply the two, the post-acquisition market value is 4,257,000,000 naira. So this gives us the post-acquisition market value. Now, with this post-acquisition market value, examiner is asking you to determine step 3 is to now determine the additional equity value created. Like I said, the additional equity value created will represent the difference between the post-acquisition market value and the pre-acquisition market value of the combined company. So we have calculated the post-acquisition market value to be 4257. The pre-acquisition market value is 3604. The difference is 653 million, which represent the additional equity value created. So you can then say the additional equity value created when combining MK and ZK Limited is 653 million naira. You pocket it, yes. So examiner says you should determine the additional equity value created, and that's what you have done. 4 marks, you pocket it. The next one is to then calculate the percentage gain to each of MK's Limited and ZK Limited shareholder group under each payment. This examiner is wicked though. So number B2, you want to estimate percentage gain, all right? To calculate your gain, you are going to do it in 2 folds. You do for Naira, gain per share, you also determine percentage gain, all right? So how do you do this? There are 2 payment methods in the question. We have cash payments, we also have a share exchange, right? So how do you then determine the gain? Now, in this case, we're assuming that the MK Limited is going to pay per share. It's going to pay 66 kobo. According to the question, let's go back to the question where you have information on the payment method. Yes, you are told that the last paragraph there, MK Limited has proposed to pay for acquiring ZK Limited either through a cash offer of 66 kobo for a ZK Limited share. All right. So for a ZK Limited share, you have to pay 66 kobo. So in this case, the number of shares of ZK is 2 million shares. So 2 million multiplied by 0.66. So you get the total value. All right, you get the total value if you are paying cash. Or the company can also decide to pay through share exchange by offering one of MK Limited share for every 3 shares of ZK Limited. That is 1/3 of shares of MK. That is 1/3 of 2 million shares. That will give you 6667 or something. But let's go back to our workings. Okay, so in this case, I want to determine first thing first. I want to determine gain to shareholders of Kola Limited, because you are told that for the shareholders of the 2 companies. So for ZK Limited, let's use ZK instead of Kola, because the shareholders of Kola is the same shareholder of ZK Limited. Okay, so MK Limited is required to pay 66 kobo per share to acquire ZK Limited. So 66 kobo. When you multiply 66 kobo by 2 million shares, there are 2 million shares in ZK Limited. So that will give us 1,320 million naira. So the total amount that MK Limited will pay to the shareholders of ZK Limited is 1,320 million, or we can say 1.32 billion naira. So that is for that. So you now need to determine, pay attention to this. This 1,320 million shares is the total amount that MK Limited will pay to the shareholders of ZK Limited. Examiner, I've told you anytime the examiner mentions shareholders, you need to calculate your value up to per share. Therefore, you need to now calculate the value per share. To get the value per share, the total market value, you have the total market value currently, the current price per share of ZK Limited is the total market value of 1201 over the number of shares of 2 million. So when you divide that, 60 kobo is the current share price of ZK Limited. ZK Limited has a current share per share of 60 kobo. So you now need to determine, you want to pay 66 kobo. MK is paying 66 kobo. Your current market price is 60 kobo. Have you made any gain? Yes. The gain will then be what MK Limited is paying, which is 66 kobo, minus what your current share price is, which is 60 kobo. So the difference between 0.66 and 60 kobo will give us 6 kobo. 6 kobo is the gain per share. To now get the percentage, you divide it by the old value, which is 60. So multiply by 100%, we have a gain of 10%. So if MK Limited offer to pay 66 kobo in cash per share to the shareholders of ZK Limited, the shareholders of ZK Limited will gain 10%. We gain 10% on their shares. So we gain 10% on the amount, on the cash. That is 10% of or 10%, or we say 0.06. Okay, 10% of 66 kobo that you are paying. That will give you 0.06. So that is for that. Then you also need to determine for what will be the gain to the shareholders of MK Limited. Now, how do you determine the gain to the shareholders of MK Limited? To do this, remember, the shareholders of MK Limited has acquired ZK Limited. Therefore, you need to first of all determine the post-acquisition market price per share. You need to determine the post-acquisition market price per share. Then, of course, you need to determine the pre-acquisition market price per share. So the difference between the post-acquisition market price per share and the pre-acquisition market price per share will give you the gain that the shareholders of MK Limited will earn. So in this case, the post-acquisition market price, remember, the total post-acquisition market value is 4,259. Out of this, MK Limited is expected to pay cash of 66 kobo per share. When you multiply that by 2 million shares, that will give us 1,320. So the difference between 4,257 and 1,320 will be the gain, will be the post-acquisition market value. What will be left? What will be left after you have paid that a cash of 1,320? So we have 2,937. You now divide it by the number of shares of MK Limited. Number of shares of MK Limited is 1,200. All right. So when you divide it, you have post-acquisition market value per share to be 2.45. You then calculate the pre-acquisition market value of MK Limited. All right. So the current market value The pre-acquisition market value of MK Limited, as calculated above, we have done it before, is 2403. The number of shares of MK is 1200. When you divide, you have 2 naira per share. So the current market price per share of MK is 2 naira. When you now less the difference, you need to find the difference between the post-acquisition market price per share and the pre-acquisition market price per share of MK. So that's what gave us the 0.45. So what will be the gain of the gain arising from this acquisition to the shareholders of MK Limited is 45 kobo per share. So to get the percentage, just divide the 45 kobo by the current market price per share, which is 2 naira. So that will give you 22.5%. So the gain to the shareholders of MK Limited is 22.5%. Okay, this is on one side. This is on one side because the examiner says you should use under cash payment. This is how you are going to treat it, under cash payment. All right, what did I say here? Okay, this is just an overall information. Overall, the shareholders of ZK Limited will gain 6 kobo per share or 6 kobo or 10% per share, while shareholders of MK Limited will gain 45 kobo or 22.5% per share if MK Limited pays cash to acquire ZK Limited. So that answers the first one. The second one, you have to determine the gain using share exchange. So through share exchange, if ZK Limited offers shares to the shareholders of ZK Limited, if MK offers shares for the acquisition of ZK Limited, what will be the gain for the shareholders of both companies? Therefore, first thing first, we are told in the question that MK Limited will offer 1 for 2 shares of ZK Limited. The share of ZK Limited is 2 million. All right. Share of ZK Limited is 2 million. So 1 for 3, that is 1 divided by 3 multiplied by 2 million shares. That will give us 67 million shares. So if ZK Limited offer 1 to 3 shares of ZK Limited, the total number of shares that MK Limited will offer to ZK Limited is 667 million shares. That is on one side. Then you need to determine the post-acquisition number of shares. Remember, after the acquisition, you need to determine the post-acquisition number of shares. So the post-acquisition number of shares will be the number of shares of MK Limited plus the number of shares issued to ZK Limited. The number of shares of MK is 1,200. MK Limited has issued shares of 667 to ZK Limited shareholders. When you add the two together, the post-acquisition number of shares is 1867. Now that we have the post-acquisition number of shares, then you need to determine post-acquisition market price per share. So to get the post-acquisition market price per share, it will be post-acquisition market value divided by the post-acquisition number of shares. All right. So the post-acquisition market value per share is 42.57. The post-acquisition number of shares, we have calculated it to be 1867. When you divide 42.57 by 1867, we have 2 naira 28 kobo. Therefore, the gain to shareholders, this is just the post-acquisition market price per share. So you then need to compare this with the current share price. Now, what would then be the gain to the shareholders of ZK Limited if MK Limited offer 1 to 3 shares of ZK Limited? First thing first, you need to determine the current market price per share under this basis. You are offering 1 for 3. The current market price is 60 kobo. We have calculated it to be 60 kobo. Okay, let me show you again how we arrive at the 60 kobo. I think, let me go back. Yes, you see it there. We have done it here. That's the 60 kobo. The market value of ZK is 1201. The number of shares is 2 million. So that's what gave us the 60 kobo. Yeah. So when you now multiply that 60 kobo by 3, it's 1 for 3. So 3 shares in ZK Limited multiplied by the price per share, which is 60 kobo. So we have 1 naira 80 kobo. So the current market price per share of ZK is 1 naira 80 kobo. To now determine the gain to shareholders of ZK Limited, the post-acquisition market value of 2.28 minus the current market price per share of 1 naira 80 kobo. That's what gives us the 0.48 per share. So the gain to the shareholders of ZK Limited is 48 kobo. To now determine the percentage gain, it will be the gain divided by the old price. The old price is 1 naira 80 kobo. So 0.48 multiplied by 1.8, that's what gives us the 26.7%. So if the shareholders of the shareholders of MK decided to issue shares to to acquire ZK Limited, then the total gain will be 48 kobo, or 26.7%. Okay, 48 kobo per share. Now, some people are sending messages, sir, why did we use average? No, I've passed that one. Am I the only one that think he is too fast? Okay. See, you say I'm too fast. Sarah, one question over 2 hours. This is 2 hours, and you say I'm too fast. All right. When you listen to the video, you'll get it better. You can imagine if I slower than this, you can imagine where we will be by now. All right. Don't worry. By the time you listen to the video, you will understand better. Sorry about that. Okay, then. Now, so we have determined the value, the gain to the shareholders of ZK Limited. The next thing we want to do is to determine the gain to the shareholders of MK Limited. All right. So first thing first, just like the way we did for shareholders of ZK Limited, what is the current market value of MK Limited? Current market value per share of MK Limited. We have calculated it before to be two naira. Let's go up there. We have calculated it to be 2 naira. This is it. This is the pre-acquisition market price per share of ZK, of MK, which is 2 naira. Okay, we have calculated it before to be 2 naira. All right. Therefore, you now less the post-acquisition market price. The post-acquisition market price is 2 naira 28 kobo. The pre-acquisition market price of MK is 2 naira. The difference is 0.28 per share. Therefore, if you now want to determine gain in percentage, that will be the gain in naira divided by the old price. So 0.28 divided by 2 naira multiplied by 100% will give us 14%. So which means that in the overall, the shareholders of ZK Limited will gain 48 kobo or 26.7% per share, while the shareholders of MK Limited will gain 28 kobo or 14% per share if MK Limited issue 1 for 3 shares to acquire ZK Limited. So that answers number B2. We are going to number B3. We're almost done. Number B3, you have to determine the impact of MK's limited capital structure under each payment method. So 5 marks. Examiner wants you to determine what would be the debt equity proportion. What would be the debt equity proportion after the acquisition of ZK Limited? All right, look at what did I say here? Here, you are required to determine the debt equity proportion after the acquisition of ZK Limited under each payment method. So, how do you determine how will it impact the capital structure of after the business combination? When MK Limited acquires ZK Limited, what will be the capital structure? When you talk about capital structure, you are talking about debt equity proportion. What is the value after the acquisition? What is the value of debt? What is the value of equity? You add the two together to give you the total value. Before the acquisition, what is the total market value of equity? What is the total market value of debt? Then you now find the difference. You find the proportion. What has changed? That's what examiner is asking you. So to do this, if the company is paying cash to acquire ZK Limited, first thing first, to determine the debt equity proportion after this acquisition, you need to determine the post-acquisition equity value after paying cash. The post-acquisition market value is 42.57. Now, if the company decides to pay cash, out of this 42.57, the company is expected to pay cash of 66 kobo. When you multiply 66 kobo by the number of shares, 2 million shares, so we have 1,320. We have 1,320. We have calculated it before. So the difference between the two will give us post-acquisition equity value after paying cash to be 2,937. You keep it on one side. You also need to calculate the pre-acquisition market value of MK Limited. We have calculated the pre-acquisition market value of MK Limited to be 2,403. Then, this has not given me what I'm looking for. Now, according to the question, the total market value, the pre-acquisition as of today, before the acquisition, the market value of MK Limited is 2,403. This market value of 2.403 will be divided into two, will be shared into two. We have debt, we have equity. You are told that the current debts, the value of debts out of these 2.4 is 40 to 60. Examiner says you should share 40 to 60, which means that the debt equity ratio of MK Limited is 40 to 60. So which means debt will be 40, equity will be 60. So you take 40% of 2,403. So that will give you 961 million. So the value, the pre-acquisition market value of debt of MK Limited is 961. Not only that, examiner also told in the question, if you are paying cash to acquire ZK Limited, the company will need to borrow money. Let's go back to the question. Examiner told you in the question that MK Limited will borrow the money needed to pay for the acquisition. So that means you are going to expose to additional debt. So how much are you borrowing? The company is expected to borrow the entire 100. You want to pay 1,320 to the shareholders of ZK Limited. So that means you are going to borrow the money. You are going to borrow the 1,320. Not only that, remember, in the capital structure of ZK Limited, we have both equity and debt. You are told in the question that ZK Limited will take over the loan note B of 400 million naira in market value terms. So if MK Limited is going to acquire ZK Limited, you're also going to acquire the entire both asset and liability. Therefore, MK Limited will also take over 400 million loan note B of ZK. All right. Therefore, you need to add up what will then be the post-acquisition debt value. The post-acquisition debt value will then be the 951 million naira that MK Limited has in its capital structure. 951 million naira is the value of debt that MK has in its capital structure, plus the amount that MK Limited will borrow to pay for cash to ZK Limited, which is 1,320, plus the debt taken over from ZK Limited for loan note B, which is 400. When you add the three together, that will give you 2681. 2681. The way examiner solved this, I have a divergent opinion to that, because when you look at the debt equity proportion given to the question for MK, it is expressly stated that debt equity proportion is 40 to 60 for ZK. But when you look at the solution given by the examiner divided 60 over 60. You want to determine the proportion of the market value. Why are you dividing 40 by 60 to get the proportion of debt? I don't know. Maybe that is a mistake or is a typo somewhere. I did that is not what you should. If you say 40 is debt, 60 is equity, which means that 40% is for debt, 60% is for equity. Take 40% of the total pre-acquisition market value. So that's what gave us the 961. But examiner did not treat it that way. Examiner said 40 over 60, that is debt over equity. Debt over equity multiplied by the value of 2403. This is not correct. This is maybe the preparer of the solution. I don't know how the assumption behind that. To me, is not correct. I can't accept that calculation. So this is what it should be. If you say debt equity proportion is 40 to 60, it means debt is 40, equity is 60. Except if you want me to use total value. If you want me to use total value, then it will be debt over debt plus equity. So which means that in this case, debt will be equal to 40, equity will be equal to 40 plus 60, which is it will then be equal to 40 to 100, which means that debt will be 40, equity will be 100%. Yes, Minister of Finance.
Yes, so now that you're mentioning this debt to equity ratio, I want to ask that we've solved two illustrations regarding this. And the first one, we did it using total value. And the second one we did again, we didn't follow that route with the same information examiner gave. So I don't know what justify our use for this debt to total equity value. I mean total debt to debt equity value.
Yes, that means you have not been reading. So I told you, anytime an examiner define the gearing ratio, you have to follow the instruction. In the one you mentioned, examiner specifically defined for you that long-term debt over long-term plus equity. Long-term debt plus equity. So examiner has defined it for you in that question that debt over debt is gearing ratio is debt over debt plus equity. That is, you are supposed to do it like this one. Anytime the examiner defines your gearing ratio for you as total value, that is debt over debt plus equity, this is what you are going to do. But if in the question you are given debt equity proportion and the examiner did not define it, like in this case now, debt equity proportion is 40 to 60. Examiner did not tell us to use total value. So in this case, it will be debt will be equal to 40%, equity will be equal to 60%. But if examiner specifically tell you that, okay, your gearing ratio should be debt over debt plus equity, then you need to use the total value. That was my explanation in the class when I was taking you cost of capital, even when we had the valuation in our second or third illustration. So this is what you need to do. You need to understand. But where examiner is silent, you are not told. You are just given debt equity proportion, gearing ratio. Examiner did not define it for you. Then you are at liberty to either use the total value or you use debt over equity. When you say debt over equity, this will be debt over equity. In this case, debt will be equal to 40%, equity will be 60%. But if you are using total value, the total value will be debt over debt plus equity. So in this case, debt will be 40, equity will be 100, based on the ratio of 40 to 60. I believe that is clear. Minister of Finance.
Thank you, sir.
All right. So that is how we got the post-acquisition market value of 2681, market value of debt to be 2681. Like I said, this is different from the way, because I can use 60 or whoever that prepared the solution, calculate debt value by saying debt, the ratio of debt over ratio of equity multiplied by the market value. And I said that appears incorrect to me. I don't know the basis of doing that, which is to me is not acceptable. In any case, this is the way I believe it should be. All right, so you can then compare this with the solution you have in the Pathfinder to know whether that particular portion makes sense. All right, then the next one. Now we have determined the post-acquisition debt value to be 2681. We have also determined the post-acquisition value. Okay, we have determined the post-acquisition total value. To get the post-acquisition total value is the market value of equity plus market value of debt. The total market value of debt, we have calculated it to be 2681. Then the total market value of equity after paying cash is 2932. That's the 293237 rather. When you add the two together, the post-acquisition market value of equity and debt will be equal to 5618. So you want to know after the acquisition of ZK Limited by MK Limited, what will be the capital structure? What will be the debt equity proportion? Therefore, the value of debt, the total value of debt is 2681 divided by the total value of equity and debt, which is equal to 5618, multiplied with 100%, 48%. 48% is the debt equity proportion, which means that debt is 48%, equity is 52%. Remember, the current debt equity ratio of MK Limited is 40 to 60. After the acquisition of MK Limited, sorry, of ZK Limited, it has increased to 48 to 52. 48 to 52. So that means the gearing ratio has increased. So that is the impact. The gearing level has increased. Of course, it's expected because you are borrowing loan to pay 1,320,000. You're also taking over of the debts of ZK Limited of 400 million naira for loan note B. So it's expected that your gearing ratio will also increase. All right. So that is for that. Then, if the company is paying share, is offering share as a method of the acquisition, then what will be the impact on the capital structure? So to do this, the same way you have done for cash payments. So under share exchange, the post-acquisition market value, we have calculated it to be 4257. The pre-acquisition market value of MK still remains the same as 2403. Then MK Limited current debts. In its capital structure, the current debt of MK Limited is 40% of the total market value, which is 961. Debt to be taken over because, again, like I said, since MK is acquiring ZK Limited, we are acquiring both asset and liability. Therefore, the liability in the balance sheet of ZK Limited is loan note B, which is 400 million. So to now get the post-acquisition debt value, so you need to pick the debt value of MK Limited plus the debt taken over, which is 400. 961 plus 400 will give us 1361. All right, we give us 1361. Then, of course, the next thing you need to do is to now get the total market value. What is the total value of equity and debt? Total value of equity and debt. Total value of equity, we calculated it to 4257. That's the post-acquisition market value plus the debt value. Debt value is 1361. When you add the two, still remain the same thing as 5618. To now determine the new gearing after the acquisition, it will be the total debt of 1361 over total market value of equity and debt multiplied by 100%. So we have 24%. 24%. So which means that debt is 24%, equity is 76%. So like I mentioned here also, note, it is assumed that MK Limited will take over ZK Limited loan note B of 400, which is expected because you cannot acquire a company. You only acquire assets. Who will take care of the liability? So when you are acquiring a company, you have to acquire both assets and the liability. All right. So that answers number B. Let me know if you have any question on this before we proceed. Number C, I won't say anything. I'll just show you how I determine that. So in the absence of no other question, let me go to number C quickly. You are to evaluate the financial and other factors that both MK's Limited shareholders and ZK Limited shareholders would consider prior to agreeing to the acquisition and the impact of the MK's Limited capital structure under each payment method. All right. So to do this, of course, I've already provided the solution for you, so you can just go through it. I don't need to, they are just written ones. So you go through it and I've simplified it for you. So you know what to just go through it and You have your answer to that. All right. So that is the question. That is the question. Generally, let me know if you have any question on this so that we'll move to the next one. You can see 2 hours, just one question. No. Of course, on the day of your exam, you can't be spending 2 hours on one question because I'm explaining. So that's why. In fact, about 3 or 2 people read this question. So all this thing takes time. All right. So, in the absence of no further question, then let's have one more illustration before we move to merger and acquisition. Let's have one more illustration. Let me see if I have space here. Okay, no worries. Now, there's a particular question I will want us to solve together. The reason being that um, it's a different scenario and it's very straightforward. But if you don't know, you don't know, no matter how cheap is the question. This question was tested in 2017. Now, whenever you are given a question and you are given 2 different periods, all right, you are given 2 different years, information, you are given a financial statement of 2 different periods. Like in this question, we have for the first year and the second year, and you want to calculate free cash flow. That means you need to check for movements in working capital, movements in non-current assets, movements in short-term financing or long-term financing. So when you have this kind of information, how do you calculate your changes in working capital? How do you calculate your changes in non-current asset? How do you determine whether additional loan or debt have been borrowed? All right. So let's use this question to demonstrate that quickly. Let me share with you this information. Okay, when you go to your study material, illustration number 3, go to illustration number 3 in your study material. I think that's page 82. Page 82. Let's quickly try that question together. Okay, let me share. What did I say? Sure. My intention was to just solve this question within 1 hour, and now we are spending 2 hours plus. You can imagine. Oh yeah, quickly. Yes, I need one of you to read for us, please. Illustration number 3. Who is helping us?
Lamborghini Limited, a food packaging company, has operated as a private company for the past 10 years. The company has been growing rapidly over the last few years. The directors are now considering listing the company on the stock market. Preparatory to this, the directors are interested in determining a fair price per share for the company. Assume today is November 1st, 2016. The following information has been extracted from the most recent audited financial statement of Lamborghini Limited. We have the statement of financial position and P&L. The following additional facts are available. The directors believe that the free cash flow to equity model should provide appropriate valuation for the company share. An investment banker has provided the following estimate of cost of capital, cost of equity 15%, post-tax cost of debt 4%, WACC 12.5%. The directors believe that the free cash flow to equity will grow by 18% for the next 5 years and by 5% thereafter. The company currently has 600 million shares in issue required. Calculate free cash flow available to equity for the year ended October 31st, 2016. B, use free cash flow to equity model to calculate current value per share. And C, what are the key advantage and disadvantage of stock exchange listing?
Yeah, thank you very much, Tolu. That is the question. Without wasting more time, examiner is asking you to calculate free cash flow to equity. All right. For how many years? What's the initial period? Initial period is the next 5 years. So without wasting time, let me stop sharing this and quickly move to this one shouldn't take us more than 20 minutes maximum. All right. So I want to calculate This is solution. Solution to illustration number 3. That's page 80. What did I say? What page again? Remind me. Is it
82.
82. Okay, thank you. So the name of the company is Lamborghini Limited. Lamborghini is a limited liability company. All right. So how do you value a limited liability company using cash flow basis? This company is going for stock exchange listing. All right. And the examiner says you should calculate free cash flow. You should calculate free cash flow. Should I even type it or I'll be writing it down? Anyway, let's just go ahead. Let me use pen. So you have to calculate free cash flow to equity for the next 5 years. So in this case, number A, calculating free cash flow to equity. Figures are in million. All right. So this will be for year 1, year 2, year 3, year 4, and then year 5. So examiner has given us in the question, you have been given a free cash flow to the firm. Let me go back to the question. How much is the free cash flow to the firm given to us? Examiner, we are not given free cash flow to the firm, so that means we are the one that will calculate it by ourselves. To do this, you need information on profit, you need income statements. So we are given information of profit or loss accounts for 2016. So you have options. You can either start calculating your profit before interest, your free cash flow to equity, starting from profit before interest and tax, or starting from profit after tax. Like I explained to you in the class, please don't waste your time. Start from profit after tax. You need to start from profit after tax. And profit after tax is 1054. Therefore, I would then say profits after tax, which is 1054. We are now told that this profit after tax will grow by what percentage?
18.
What's the percent? 18% will grow by 18%. Therefore, multiply by 1.18. So give it to me. 1054 multiplied by 1.18. What do you have?
1244.
1244 multiplied by 1.18.
1468.
1468 multiplied by 1.18.
1732.
Next, multiply by 1.18.
2043.
243.
2043. Next,
2411.
2411. Okay, 2411. Then
Interest.
the next item will then be, remember, before arriving at profit after tax, you have deducted interest, you have also deducted tax. Therefore, you ignore those items. That's why it's better for you to start from profit after tax. So the next you are going to do now is to add back non-cash item. So I will then go to the question. I want to add back non-cash item. Hold on first. Let me even go back to the question. You are told in the question that, let me see, the director believed that free cash should provide a valuation of the share. The director believed that the free cash flow to equity will grow by 18%. Oh, okay. First thing first, before we even start the growing, let's just calculate the current. Let's do it this way. Let's calculate the current free cash flow to the firm. Before this, let's redo this, because the information says that means we need to first of all calculate the free cash flow. before we begin to grow. So I will come here, PAT, profit after tax. The profit after tax is 1054. All right. Then before arriving at this, they have charged interest and also tax. So ignore those information. The next thing we need to do is to add back non-cash item. In the question, you are given depreciation. How much is depreciation?
440.
440. Okay, 440. You had it back. After depreciation, we need to consider changes in working capital. Now, in the question, examiner did not I'm not sure if examiner mentioned working capital. Examiner did not talk about working capital, but it is implied in the question. It's implied in the question. To get information on working capital, you go to the statement of financial position. Go and check under current assets. Is there any movement in current assets? Your cash, of course, when you are calculating working capital, you don't include cash, so you ignore cash. Your receivable in 2016 and 2015 are different. Your inventory in 2016 and 2015 are different. That means there is a movement. Therefore, we need to go and do workings. So I will then come here. We are coming back to this. So we need to go and calculate changes in working capital. So let's go and do working for that. Let me push this one down. Let me see. I did not create sufficient space. Let me just copy. It will move all the things that I've done. Let me just, okay, let me do this way. Control Int. Okay, right. Let me create additional space. All right. Okay then, so we want to do workings without going too far. Let's do our workings there. So the working number one, we want to determine changes in working capital. We want to know whether working capital has increased or reduces. We have two different years, 2015, 2016, and the change that has taken place. So we have account receivable. We have receivable. In 2015, how much was receivables?
980.
980.
542.
Then 2016,
1072.
1072. Before, customers are owing us 980 million. Now the debt has increased to 1072. Customer receivable has increased to 1072. What's the difference?
92.
92.
So that means more cash has gone out. This is cash outflow. Put it in brackets. We also have inventories. In 2015, how much was inventories?
2078.
2078. 2016?
2542.
2542. What's the difference?
464.
464. Again, before we bought inventory of 2078, it has increased. We have bought more by 464. So it's a cash outflow. What else do we have in the current assets? Under current asset, what other information? So we also have accounts payable, right?
Yes.
So I would then say payables. How much is account payable in 2015?
2792.
2792. In 2016?
3084.
3084. 2,684. This means that in 2015, where the company is owing suppliers, the company is owing supplier 2,792. In 2016, it has borrowed more. I mean, it has collected more goods. It has collected more, so the owing has increased to 3084. So that means this is a plus to the company. More cash has come in. The company has more cash has come in. So the difference is what?
292.
292. That's a plus. So find me the difference.
264 negative.
264. So this represents increase in working capital. So changes in working capital by 264. You can calculate for other years. I don't need it. The total is what I need. So I can then go back. Changes in working capital is 264 negative. This is working number 1. Okay. Now, after changes in working capital, you also need to consider if additional non-current assets have been purchased. You want to know if the company has purchased additional non-current assets. To do this, you go back to the balance sheet given to you, statement of financial position. You are given non-current asset for each year. The values are different. Therefore, there is a movement. So quickly, we need to go and do working on this. We need to go and calculate additional non-current asset purchased. So, working number 2, additional, we want to know if additional non-current assets has been purchased. So in this case, I can either use a T format or I use formula. If I want to use a T format to do this, to use a T format, you know that asset is a debit balance. Asset has a debit balance. Therefore, we are going to have balance brought forward. We also have balance carried down. Of course, we also have P&L, profit and loss account. Under the profit and loss account, we need information on depreciation. So I will then go to the question. How much is the balance brought in 2015? What is the value of non-current assets in the balance sheet?
5942.
5942. In 2016, what's the value of non-current assets?
6224.
6224. You then had depreciation of 440. Okay, so this will give us 6664 minus 5942. What do you have?
722.
So additional non-current asset purchase is 722. So this is how to determine whether additional non-current asset has been purchased. If I don't want to follow this route, right? If I don't want to follow this method, let me create additional space. So let me go back. So if I don't want to follow this route, I can as well use a formula to get the same thing. So to use formula addition, I believe you might have done this under a statement of cash flow. All right. So to know whether additional non-current assets have been purchased, you are going to pick the closing non-current assets. Closing non-current assets, you had P&L, that is, you had depreciation. Then you minus minus opening non-current assets. So it's the same thing you are going to get. So here will be 6224 plus 440 minus 5942. So this will give you the same amount as 722 million. Okay, whichever one that is more convenient for you. So 722. So I can say capital expenditure 722. It's a cash outflow. Cash is going out. Working number 2. Then after capital expenditure, we also need to consider if there's any loan repayment, loan or debt repayment, or proceeds from debt issued. I will then go to the question to go and check if there's an additional loan. To do this, you go to the section of the question that talk about, when you are in your statement of cash flow, there are three phases or there are three categories of your statement of cash flow. We have cash flow from operating activity, cash flow from investing, then cash flow from financing. We have done cash flow from operation. That's where we have the changes in working capital. We have done cash flow from investing, which is where we have additional non-current assets. Then we need to determine the cash flow from financing. So I will then go to the question, what are the method of financing given in this question? When you go to the statement of financial position, we have current liability. Under the current liability, we have short-term loans. Short-term loans is method of financing. It will come under financing. We also have non-current liability, that is bonds. So therefore, we need to go and check the movement. We need to check for the movement. In this case, I can then say working number 3. We want to know if additional debts have been borrowed or additional loan have been borrowed. So loan. So we have 2015, 2016, and then change. All right. So in 2015, we have we have a bond. How much is bonds in 2015? Yes.
25.
2,500. In 2016?
24.
24. You can see the company was owing 2.5 billion in 2015. The debt has reduced to 2.4. That means the company has paid back part of the loans. So that means there's a cash outflow of 100. There's a cash outflow of 100. Let me call this additional loan. Additional loan. I don't know whether it's going to be additional loan or loan receipt. Oh, yeah. So then we have short-term loans. In 2015, how much was short-term loans?
1432.
1432. In 2016,
1936.
1936. So what's the difference?
504.
504. This is cash outflow. So the difference between these two, that will give us 404, right?
Yes.
So additional loans have been borrowed. The company has borrowed additional loans. So that's a plus. More cash has come in. More cash has come in. Therefore, we need to go and indicate that. So let's go back to our table. Working note 3, additional loan. Additional loans. 404 is a plus. Working number 3. So that's all. Add it up. What do you have?
912.
912. This represents the free cash flow to equity. This represents so you can use other methods. You can start from earning before interest and just for your own practice. I'm not saying you should on the day of your exam. You should use start from PAT, then you start from earning before interest. It's a waste of time. Just use one and move on. But again, for the purpose of practicing, you can start from earning before interest and tax just to know whether you are going to arrive at the same answer. Remember, I gave you 3 formats for calculating free cash flow to equity. I gave you 2 formats for calculating free cash flow to firm. I will expect that by now you would have mastered each format. So that because there's nothing you want to do in valuation that relates to cash flow, whereby you are not going to use free cash flow to, you are not going to calculate free cash flow. All right, so we are done. We are done with the first requirement. In the first requirement, examiner says you should calculate free cash flow to equity, 7 marks. Then you are now asked to use the free cash flow to calculate the market price per share. So to do this, what am I supposed to do? I can still use this table. Yeah, let me see. Number B, we have to calculating market value of Lamborghini Limited. Figures are in million. So examiner now told you that you should grow your free cash flow by 18% for the next 5 years. So this will be for year 1, year 2, year 3, year 4, and then year 5. Our current free cash flow to equity, we have calculated 912 million. We are now told that this free cash flow will grow by 18% for the next 5 years. So multiply by 1.18. So give it to me. What do we have? Year 1.
1076.
Next.
1270.
0.
Yes.
Next.
1498.
Next.
1768.
And then?
2086.
Okay. So we have grown the free cash flow to equity. The next thing we need to do now is to now discount this free cash flow to equity using the appropriate cost of capital. So we then go back to the question, how are we going to discount the free cash flow? According to the question, you are told that an investment banker has provided the following estimate of cost of capital. You are given cost of equity of 15%. You're also given WACC of 12.5%. You have to use apple for apple. You have calculated free cash flow to equity. Then you must use cost of equity to discount the free cash flow. If you have calculated free cash flow to the firm, then you are supposed to use the WACC of 12.5. But because we calculated free cash flow to equity, we are using 15%. Okay, we are using 15%. So I will then come here at 15%. Give it to me, year 1 at 15%.
0.870.
Next.
0.756.
Next.
658.65.
0.658.
Next.
0.572.
And year 5.
0.497.
Okay, so that's that. So since of course, the next thing we need to do is to just get the present value. So give it to me year by year.
Last year.
936.
Yeah.
First one.
936. And last year, Mr. Finance.
1037.
1037.
Second year.
Yep.
Second year, 960.
960.
Year 4, 1011.
1011.
987. 986. Year 3.
986.
986.
So add it up. We have present value of year 1 to 5. Give it to me. Add it up.
4,930.
4,930. 4,930. So the total present value, total market value of Lamborghini Limited for the next 5 years is 4,930,000,000 naira. So we then need to calculate free cash flow you need to calculate market price or market value from initial period to infinity. Initial period end in year 5. So from year 6 to infinity, we need to calculate the terminal value. So here will be PV of year 6 to infinity, which is equal to free cash flow to equity of the base year. What's the growth rate after year 5?
5%.
So 1.05. Cost of equity is 15%, 0.15, minus the growth rate of 5%, multiplied by discount factor. Oh, sorry. I wanted to write formula first. This is 1 plus G. Cost of equity minus the growth rate multiplied by discount factor of the base year. So here will be the free cash flow of the base year is 2086. That is, you are picking the free cash flow of year 5. Year 5 is the base year. Growth rate is 5% after year 5. So 1.05 over cost of equity of 15% minus growth rate of 5%. Discount factor of year 5 is 0.497. Give it to me. What do you have?
10,886.
10,886. Is equal to 10,886. This represents the PV of year 6 to infinity. Then you need to add the total, you need to get the total present value. So total present value, that is market value of Lamborghini. What do we have there?
15,816.
15,816. So that's the total market value of Lamborghini. Examiner did not ask you to calculate total market value. You have to calculate current price per share. So you have to determine current value per share. So to now get the current value per share, so I can say, therefore, current value per share because of space equal to total market value divided by number of shares. Total market value is 15,816. Total number of shares, we are told is 600 million. 600 million shares. So what do we have here?
26.36.
So current price per share is 26.36. Okay, this is per share. That's all. 5 marks. You pocket it. Huh? So that's it. That's it. So the reason why I want us to solve this question is for you to know if you are given information for 2 periods, like in this case, you have income statement for 2015 and 2016. You also given statement of financial position for 2015 and 2016. So you need to check for movements in your statement of financial position. Is there any changes in working capital? All right. If the information under current asset and current liability are not the same, that means there's a movement. Therefore, you calculate. You already know that to calculate your cash flow, you need 3 items. You need cash flow from operation, cash flow from investing, and cash flow from financing. To get changes in working capital, you need to calculate cash flow from operation. You check movement in cash flow from operation. Then to calculate if additional non-current assets have been purchased, you need information on the investing activities. Then to know whether additional loan have been borrowed or not, then you need to consider financing activity. So that is why we have to test this question to also give you additional knowledge of how to do this. So number C part of the question, you can always read that through. It's a theory. We have done well, 3 hours since morning. So we have done well. Now, lastly, before we close the class, let's briefly talk about merger and acquisition. All right. So because I promised you, and then I have to fulfill that. Ordinarily, I would have just refer you to just go and read it. Again, it's purely theoretical. There is no calculation in merger and acquisition. But in any case, let's quickly have a look at that. All right. So without wasting more time on this, let me just share my let me see if I have Golden Book open. So I will use Golden Book. Golden Book is more explanatory than the and let me use Golden Book for the explanation. Okay. Let me quickly open it. Then the next 10 minutes I'll just give you a guide. We have done well today. Judgment Day is coming. Hey, my people in Vienna and in Solo. I think in online, I don't used to sing that song to you guys, so you are not familiar. You may not be familiar with it. But those in Vienna and in Solo will know that hey, there's no day I come to the class, I won't sing that song. Hey, just to remind you of your responsibility. That's why I used to sing that song. All right. The D-Day is finally here. Today is what? November 1st. So you have 14 days, sorry, 17 days to the D-Day. Don't worry. The time you have is still sufficient for you to perfect your study. We are going to talk more. Let's quickly focus on this within the next few minutes. Now, examiner cannot be asking you at this level, at this professional level, for you to define what is merger, what is acquisition. You won't see question under this area. The examiner will not, somebody is sending message, merger and acquisition page. Okay, yeah, page 526. That is if you are using, if you have the golden book. So if you don't have the golden book, go to your study material, you will see you see it there. You see it there. Now, briefly, let's talk about this. What do you mean by merger? Again, so for some of you that are doing SBR, strategic business reporting, Mr. whoever that took you, whether Mr. Wasil or Mr. Abi or Mr. Ibrahim, when I've taught you, when I've discussed business combination with you. All right. So there's difference between merger and acquisition, but in practice, both of them are used interchangeably. You know, it's a very sexy kind of title when you say merger and acquisition transaction, merger and acquisition, but the two of them technically they are different. Therefore, what do you mean by merger? Merger simply means that coming together of two separate entities to become a new company. When, for example, we have company A and then company B, the two of them can combine together, can merge together to become company AB or a different company entirely. They can become a different company entirely, maybe C. All right. So when the two of them amalgamate, the two of them can amalgamate. The company A and B can amalgamate to become AB or company C. So when this happens, when there is a merger, the two individual company will cease to exist. The two individual company will cease to exist because they've already become A, B, or C. So there's nothing like A, B again. So it is now AB or company C. So when this happens, you need to determine, before the merge, you need to determine what is the value of company A, what is the value of company B. Before you now determine the post-merger market value. Now, what are the purpose of merger? What are the purpose of merger? Okay, there are different reasons a company can decide to merge with one another. One is to achieve synergy. All right, a company A can merge with company B for the purpose of achieving synergy. Not only that, companies also do that for the purpose of achieving economic of sales. All right, company can do that to achieve economic of scale. All right. So because you are picking the technological, the proprietary of technological capability of different individual companies. You can, when you merge it together, you can produce large quantity at a lower cost. So it will enable the company to achieve economies of scale. Then another reason or purpose for merger for merger is to achieve what we call market expansion. Market expansion. So company can do that for the purpose of having a larger share in the market. For example, in 1998, if I remember clearly, in 1990, prior to 1998, prior to merger of Exxon Corporation and Mobil Corporation in the oil and gas industry, Exxon Corporation is number one, used to be number one in the late 90s. Okay, in the late 90s, Exxon Corporation used to be number one oil producing company in the world. Number two was Mobil Corporation. Number two was Mobil Corporation. So in late 1998, the two of them merged together, all right, to become ExxonMobil. So you cannot imagine number one company in the world and number two company, they now merge together. What will happen in that industry? Certainly, they are going to have a bigger market share. That was the intention. That was the intention of that acquisition of that business combination. So when two companies merge together, three or more things can happen. One is to achieve economies of scale. Then two is to achieve market expansion. That is, you have a larger market shares. Then number three is to achieve synergy, because we believe that there's a benefit, there's a perceived benefit, there's a potential benefit from two of us coming together. All right. So that is basically acquisition. Sorry, merger. Let's briefly talk about acquisition. Okay. What do you mean by acquisition? Acquisition will arise when an entity or when a company acquires controlling interest in another entity. Okay, when a company acquires controlling interest in another entity. When you say controlling interest, when you acquire over 50%, let's say for example 51% interest in another entity, that means there's an acquisition. So when you have an acquisition, of course, in this case, the smaller company, the acquiring entity or the acquired entity will seek to assist, or it can become a subsidiary of the acquiring entity. Okay, it can become a subsidiary of an acquiring entity. What I'm trying to say in essence is that, let's say for example, we have company A, we also have company B. So company A acquires, when company A acquires 51% in company B, so that means that, of course, this is what is known as acquisition. So when there is acquisition, this company B can either cease to exist. This company B, let me put it this way. The company B can cease operation, or it will become a subsidiary. It will become a subsidiary of the acquiring entity. All right. So that is acquisition. So a new company does not emerge when there is an acquisition. There is no new company that will emerge. So it is the acquired company. It is the acquired company or target firm that will be consumed and will cease to exist. That company will cease to exist. Okay, so the company can the acquired company will cease to exist, or it can become a subsidiary. It can become a subsidiary of the target of the acquiring entity. So that is basically what acquisition is all about. That is what acquisition is all about. However, what are the purpose of acquisition? Just like you have the reasons for merger, we also have reasons for acquisition. Now, one of the reasons for acquisition is to expand operation. Company might want to expand operation. So as a result of that, instead of starting all over, they can acquire an entity that is in the same industry or even in different industry, because again, it's not compulsory that it has to be in the same industry. All right. So to achieve market expansion, then a company can acquire another entity. Not only that, it is possible that the acquiring entity is not in the same industry with the target company. Therefore, if the company wants to enter new market, then you also carry out acquisition. So that is, acquisition can be done for the purpose of entering a new market. So instead of you to start all over, you don't know what is happening in that industry, you don't have the experience in that industry, but there's a company already operating there, and you believe that by acquiring the entity, you'll be able to tap from the market share of that industry and then make it better. All right, so that is an acquisition. That is one of the reasons for acquisition. Another one is to eliminate competition. Okay, you acquire an entity for the purpose of eliminating competition. Some of these tech companies are very good in doing this. They are very good in doing this. There was a time WhatsApp was acquired by Facebook. WhatsApp used to be owned by a different entity, but I've forgotten the years now. Let's about 5, 6 years ago or thereabout. So it used to be owned by a particular company, all right, IT company. But all of a sudden, we just heard that Facebook has acquired the WhatsApp. Okay, that's good, because WhatsApp was, Facebook is a social media platform. WhatsApp is also a social media platform. And then the Facebook management or company, they've seen that, oh, there will be a potential benefit. Why don't we just acquire this company, so that instead of our users, okay, instead of our users to be going to WhatsApp, that means they are going to split between WhatsApp and Facebook. Why don't we just acquire this WhatsApp so that you become part of our subsidiary? And that's what Facebook did during the time. All right. So for the purpose of eliminating competition, you can also carry out acquisition of an entity. In fact, Microsoft wanted to do it against the OpenAI. You remember when there was an issue in OpenAI, I think about a year ago or thereabouts. I can't remember the exact dates, that period I think it was 2024. Yes, OpenAI just came out, I think 3 years ago. Yeah. Shortly after, there was a problem in the company between the management and the CEO and the management, whatever. So there was an issue that the CEO of the OpenAI left for a short period, and then during the period, Microsoft was trying to co-optate the CEO of the OpenAI so that to come to Microsoft. And Microsoft is a shareholder. Microsoft is a shareholder in OpenAI. So the management of Microsoft wanted to co-optate the CEO of OpenAI, so that you can imagine what that would be, what that kind of synergy would be. You have somebody that developed the OpenAI and all of that, then it's now coming to Microsoft. Microsoft will be something else. So Microsoft did that for the purpose of try to eliminate competition in the AI business. Because right now there's no IT company without using AI, and one is better than the other. You see, so like every platform, Google has its own OpenAI now. Microsoft, after that, since Microsoft failed to co-optate the CEO of OpenAI, because shortly after that too, they resolved the issue and the guy went back to OpenAI, So, and shortly after that, Microsoft developed his own AI tool, which is a Copilot. All of them. OpenAI has his own. Google has his own. Then Microsoft, there are a whole lot of there, about 10 or 11 of them currently that are using AI. So this is you do this, you acquire another entity for the purpose of eliminating a competition. All right. So these are some of the reasons for carrying out acquisition and then merger. Now, what other things we need to discuss under this? Then you can read other ones like tender offer. The examiner cannot be asking you all of this. Cannot be asking you all of this. Then acquisition of assets. This is just the purchase of assets by one when company purchase the assets of another company. That means asset acquisition. Okay, this is not very common. This is not very common in business combination. Then we also have what we call management acquisition, that is management buyout. Okay, this is examiner can ask you this to explain management buyout. All right. So management buyout is a situation whereby executive of an entity purchase controlling interest in the company they are working for. All right. You can imagine in equity professional, for example, if directors of equity professional that are currently working for equity professional, if they decide to buy, they can decide to buy equity professional. So what they need to do is to partner with another entity, outside or a financier or a lender to help them to finance the transaction, to help them to finance this transaction. So that is basically what management buyout is all about. So yeah, so what other things now? The major area we need to, examiner can also ask, this also is examinable. Examiner can ask you the form of merger. There are several forms of merger. One of them is horizontal merger. Horizontal merger will arise when two entities operating in the same industry, all right, operating in the same industry merge together, all right? That is horizontal merger. For example, in the banking industry, we have GTB, you have Zenith Banks, you have Zenith Bank, you have UBA, you have Access Bank, you have Sterling Bank, all sorts of global banks, all those global banks rather. All of them, they are in the same industry. So that means if any one of them decide to merge together, like it is currently happening in the banking industry, effective April 1st, 2024, the Apex Bank rolled out the recapitalization exercise that all the banks should recapitalize. That means they need to change their capital structure. They need to pump in more money. They need to increase their capital base. So since then, all of them has been in the public to try to raise funds for the purpose of meeting up with the threshold. All right. So of course there are different thresholds in this situation. There are different thresholds, but I don't want to deviate into going into that. It will take me additional 5 minutes, but I can do that a few minutes after we are done with this explanation. So if need be. Now, so once if any of the banks that cannot meet up with the deadline, they can decide to merge together to become another entity. So that may likely happen to any of those banks we currently have in Nigeria that cannot meet up with the threshold, with the recapitalization threshold. According to the CBN, I think about 11 or 14 of them, as at the last time I read it, has met up with the threshold. So that is horizontal merger. The horizontal merger is a type of merger that is often because of larger companies attempting to create more efficient economic of scales. You carry out this for the purpose of achieving economic of scales. All right, economic of scale. So the main goal of horizontal merger is to create new and larger markets. You want to expand your market reach. You want to expand your market share. That is why you are merging with the same with your fellow company in the industry. Okay. So because of you, look at the way I'm sweating. So the next one, then you need to read about the benefits or the advantages of horizontal merger. I won't go through that. No time at all. Mr. Wasil is even waiting for you now. Then we have vertical merger. What do you mean by vertical merger? The vertical merger will arise between a company and its customer or supplier. Okay, between a company and its customer or supplier. So in a vertical merger, two companies previously selling or buying from each other can combine together under one ownership. For example, if I'm a manufacturer and I have a supplier of my raw material. So as a manufacturer, instead of in order to create a kind of monopoly in the market, all right, or in order to take advantage in order for me to achieve efficiency in my production, I can decide to merge with the supplier of my raw material. So what that means is that if I match with the supplier of my raw materials, that means I can dictate, I can dictate who that my former supplier will supply to. So that means I can take over of the market. So that is one of the reasons for taking out or for carrying out vertical merger. So the essence of vertical merger, there are two. One is to improve efficiency, then two, to reduce cost, all right, because I'm going to pay more if I'm still buying from the supplier. If I decide to match with the supplier, my costs will reduce, my purchasing costs will reduce. So what are the benefits of vertical merger? So you have it, so you can just go through each of them, no time again. I just want to touch this area before I let go. Again, we also have conglomerate merger. This involves two companies that have no common business goal, not common business area. They are in different industry. All right. When two companies in different industry merge together, that is conglomerate. All right. It occurs when two companies that offer varying services or are involved in different sectors of business merge together. So manufacturing company can decide to match with a service company. All right. So they are in different industry. All right. An oil and gas company can decide to match with a manufacturing or real estate company. They are not in the same industry. So that's what is known as conglomerate merger. All right. So when this type of deals occur, it can upset some of the markets because it could allow monopoly in a certain market. Yes, when you do this, of course, it will make the company to become stronger, and this can create a kind of monopoly in the market. All right. Two heavy companies coming together, that's a big one. All right. So again, you can read the benefits or advantages of conglomerate merger. Then, which other areas do I need to touch? Now, let's talk about, let me see. Now, uh, sorry for the break in transmission. It was due to my network. I was taken out by the network. Sorry about that. All right. So let's continue. Let me just let's round up. Let's round up. Um, so I was trying to explain. Let me see if the recording is still on. Okay, it's still on. So I was trying to explain, we are discussing the advantages of synergy. So again, one of the advantages of synergy is to achieve competition, to hedge. It's for competitive edge. All right. You carry out synergy for the purpose of, to achieve a competitive edge. So the combined talents and resources of the companies help to gain and maintain a competitive edge. So there are different, each individual company have different expertise embedded in them. Therefore, by the time they now come together, they will become better. So that means they are going to have a competitive edge in the industry. All right. So these are the advantages of synergy. Then what are the disadvantages? One of the disadvantages is to reduce competition. You carry out merger and acquisition for the purpose of to reduce competition. Yes, somebody is sending a chat. Yes, the decision tree is also important. I hear you. I hear you. I will share you the decision tree solution. This is one of the decision tree that I've done. So just I've done it. I've done for VN and it's solo student. It's only online student. I hold decision tree. I will share with you. No time again. All right. So the next one is for job losses. Certainly, merger and acquisition, anytime there is merger and acquisition, certainly it will result to job losses because the lowest hanging fruit, is to reduce the workforce. When two companies are merging together, certainly there will be too many duplication of roles and all of that. The company A as accountant, company B as accountant. We can't be using the two different accountants. Therefore, we need to look at the two. Who is better? Then we retain who is better. Whoever that is not too good enough, we ask the person to go. Cut across all the other units, like in finance, in marketing, in engineering, in production, whatever. So we have to reduce the workforce for the purpose of minimizing costs. So when that happens, when there's merger and acquisition, it will result in job losses. Not only that, there can also be diseconomies of scale. Okay, the increased size may lead to diseconomies of scale for the new company. How? The new company may not have the control required to run an enlarged entity. Okay, you now have so much than you can than you have capacity to manage. So this can result to diseconomies of scale. All right. So again, complex organization structure can arise as a result of that, because every company has their own different culture. All right. Every entity has its own different culture. Like I was trying to tell you the other time, I could remember I was one. I understand the ExxonMobil Corporation to a large extent. So during the merger, initially after I wasn't there when there was that merger, but I heard the information that you know, number one and number two company, then they now merged together to become one. So both companies have different culture, tradition, and all of that, the way they do their things. So once they now become one, so different entity will have, there will be a clash of culture, the clash of identity. So as a result of that, of course, that is one of the disadvantages of merger and acquisition. Okay, because like I was trying to say in the case of Exxon and Mobil, so because in Nigeria, for example, we have the Exxon category, then the Mobil categories, they are the one in the downstream. Then Mobil was operating Nigeria as Mobil Oil Nigeria. We also have a Mobil Producing Nigeria. All right. So the kind of salary that Exxon pay to their staff is higher than Exxon pay more than the mobile staff. So when they now match together, you now see the employee begin to tackle each other. How much is, I earn this, that kind of a shakara kind of thing that, okay, when you earn higher than the other, you want to show that we are better. So that kind of a culture can arise when there is a merger and acquisition transaction. Then another one is loss of proportional ownership. Yes, when the two companies merge together, the share holding of one entity and the other entity is going to dilute because additional shares, depending on the kind of acquisition. So the shareholders' proportionate holding will be lost or will be diluted, and as a result of that, that's one of the disadvantages of merger. Then now, examiner can also talk about, you need to know about synergy. Let me just brief you. So we don't need to, so you need to read about synergy. Okay, my pen has stopped working. Let me just use mouse. So you need to read about synergy because of time. Read about the types of synergy. We have cost synergy. We have financial. We have revenue synergy. We have financial synergy. So you need to read about each of them, and then what are the components of revenue synergy? What is the component of cost synergy? Then what about the financial synergy? All of this, you need to ensure you understand it, because again, synergy is an examinable area. It's not just about knowing the component of synergy or the type of synergy. You need to know what really is synergy. Okay, what is synergy? All right. So you need to know what are the types of synergy. Then after that, then you also need to know what are the reasons for merger and acquisition. You can just go through this one. Examiner really test it, but again, you never can tell. So ensure you go through it. No time. All right. No time to be discussing all of this one by one. So now you also need to know about due diligence in merger and acquisition. When you want to carry out merger and acquisition transaction, the two entities, or especially if a company wants to acquire another entity or you want to merge with another entity, you need to know you need to know the character, the kind of people that you want to do business with. Therefore, you need to carry out your own due diligence. All right, you need to carry out your own due diligence. This is necessary in order to minimize risk. All right, it's necessary that you carry out due diligence to minimize risk. Now, what are the types of due diligence? All right, there are four key areas that M&A due diligence is expected to focus on. One is strategic positioning. Then you need to know about financial due diligence. Okay, all the cash flow that you're going to use, you need to carry out your due diligence on them to be sure that they are accurate or closely, or they are accurate or near accurate, because most of the cash flow you are going to use are majorly forecast. Then all the operational assets. You need to know if company A says it has four assets, company B says it has three assets. You need to go and verify. You carry out your due diligence to verify that those assets are actually available. All right. Then you also need to consider the legal. You need to consider legal aspects of the merger and acquisition. So, is there any court issue affecting either of the companies? What are the issues? How do we resolve the issues? So, you need to know about all of this, because if there's any encumbrance in any of the companies, it may affect the value of the business after the combination. Therefore, you want to ensure that you are doing the right thing. That is the same thing as if you want to buy a land. You don't just say because a land is cheap. You then put your added financial resources to buy the land. After that, the government now tell you that okay, this land is under acquisition, or this land doesn't have a correct paper. And that's why in merger and acquisition also, you have to carry out your own due diligence. You have to carry out your own due diligence. All right. So if you have the material, please ensure you go through them. Ensure you go through them, because you don't know, especially under this topic, you don't know where examiner will come out to you. And that's why it is important for you to do this. Then the last area is a method of financing. No, we have done this in the past. So there are different methods of financing. You can finance through cash payments. You can finance through share exchange. You can finance through debt. So we have discussed this in one of our illustrations in the past. So no need to, you need to know them. Not only about them, you also need to know about the disadvantage of each method of financing. All right. What will be the impact on the business after the acquisition? So you need to know all of these issues. Now, possibly you also need to read about the regulatory framework in the merger and acquisition, especially as it has to do with the dictates of the Security and Exchange Commission. What does CAMA says about merger and acquisition transaction? So you need to read all of them through. You need to have an idea. In case the examiner is asking you, you will have something to say. Now, lastly, this is highly examinable. This is highly examinable. Examiner can ask you to explain the defensive tactics that the acquiring entity may want to put up. When the company wants to acquire another company, or a company wants to merge with another company, usually this usually throw a kind of a how will I put it? Apprehensive. The staff of individual company may become apprehensive of job loss. So they may want the business they may want the business combination to fail. They may want the business and the merger and acquisition transaction to fail, because they know that it's going to affect them. And that's why whenever you are carrying out M&A transaction, it's usually done in secrecy. Merger and acquisition transaction is usually done in secrecy. In fact, depending on the size of the companies involved, at times they can take it out of Nigeria to go and resolve it elsewhere, because they believe that if media gets to know about the impending transaction that is going to come, certainly it will become public information. When it becomes public information, the employees will become apprehensive of job loss. Then that will affect performance. So in order to ensure, and they will want to frustrate the transaction not to succeed. So in order to avoid all of these issues, what they do usually is to take it outside of the immediate environment to go and resolve it. So where do you won't have anything like media where media will get to know about it. So once they are done with everything, then of course they now come to public that they now announce the transaction that, oh, company X is acquiring company B, or company A and B is merging together and all of that. So once it become public information, the deed has been done. There's nothing anyone can do about it again. Because before this time, they would have gotten the approval from the Security and Exchange Commission, all regulatory approval would have been gotten, the one from the CBN, so depending, sorry, if it's a bank, of course, CBN too will be involved and all of that. So, but at times, the shareholders of one of the companies, say a company wants to acquire the another entity, the shareholders may not want that transaction to, some of the shareholders may not want it to happen. Therefore, they need to put off a kind of defensive tactics to prevent the takeover. So they want to prevent the takeover. So what are those things? Examiner can ask you. That's what I said. This is highly examinable. So you need to know the method of, or the tactics or mechanism, okay, that's the acquiring entity, that a target entity can put off to prevent the takeover. So you know about golden parachute. What do you mean by golden parachute? What do you mean by green may? All right, tactic. So you need to know all of this. What is macaroni defense? What is people appeal? So all these things you need to know. If you know about five of them, you are good. If you just poison pill, all of this, just know about five of them, you are good to go. If you know more than five, good for you. You also have sandbag, you have white knight. There are more than this, but these are just some of them. All right. So that is that. Criteria for now. For the online students, ah, for the online students, okay. I did not, when we started, I'm not sure if I mentioned to you the requirement for valuation. The requirement for valuation. I've done this for the solo and the online students. There are basically, I gave you in the class, I gave you about 10 different things that you should, that must be basic requirement, key basic requirement for valuation. Whenever you want to carry out evaluation, there are 10 different things that you must, the requirement that must, just like a criteria, all right? So that we discussed in the class. Let me see, I will just, what I will do is that I will write it down, then I will share with you because of time. I've really overspent, so this is almost 4 hours. So because of time, I will write it down and I will share with you. Or I will share the video recording with you. That will be better. I will share a video recording with you. So that will be better. All right. So before I give you the part the parting shot. Now, for the online students, I'm also in you a question on decision tree. So like I said, I will share a video recording with that to that effect. So because we don't have time and you need time to read. So let me know if you have any question for me before I say the last, I make my last comment for the purpose of our journey so far. Yes, any question for me?